It's a dollar against the Chinese currency that's now through 7. That's a big change from where we've been. This dollar is a whole lot stronger and yields are a whole lot higher. Those two things are connected. Yields up 4 or 5 basis points on a 10-year, 345 on a 2-year. That 2-year, Lisa, can you keep up 360, 370, 380? Are we going to be having a conversation about 4 pretty soon?
Well, that's the real question. Does this bond market start to price in the likelihood of a Fed not only raising rates to 4, but even keeping them there for as long as potentially they're saying they're going to? I mean, they're saying they're going to. People just don't believe them.
Big feature of the market conversation this morning. Big feature of the conversation here in London. Front page of the Financial Times. This is one for the city, Tom. There has been a bonus cap, so-called bonus cap for bankers since the financial crisis, at 2 times salary. So if you want to pay someone a $2 million bonus, Tom, you've got to pay them a $1 million salary. That'll make sense? Okay. Get out the small violins. They haven't been able to do more than that since the financial crisis. The Europeans have had an agreement on that, Tom. The Chancellor, the FT are reporting this morning that the Chancellor is having a serious look at getting rid of that bonus cap because they want to be very, very aggressively so, very, very pro-city.
This is, as pointed out in the article, this is fixed versus variable costs and flexibility of firms given crisis. You have less flexibility with this idiotic policy in Europe. What they need to do is to go to a realistic policy and sell it to all of the United Kingdom. If you make the city reinvigorated with a rational American-like structure, it helps the Tories, it helps Labour, it helps the Lib Dems, it helps everybody.
Do you think Labour's going to see it that way, Tom?
Don't know. You're the expert on this.
I imagine the front page of the newspapers are going to be very, very different.
Yes, I would say that they would say this is a tone-deaf timing, that basically you're trying to get people paid more at a time when everybody else is flat on their backs. That said, the sentiment of trying to get the city back up and running and make it competitive on an international scale, I understand that.
Let's take someone who's been dead on in this bear market, Marko Kolanovic over at J.P. Morgan. Okay, he's in New York. They want to.
Dead on this bear market.
It's a little sad, you know, a little humor there.
I'm just making sure the sarcasm isn't lost on anyone. That's okay.
But the bottom line is, if you've got a piece of meat in New York and you want to bring them over to London, they have no incentive to show up. Period.
Well, you want to make sure that that meat, and I don't want to call employees meat, so
that's what we used to call.
You want to make sure that individual isn't going to Paris, isn't going to the major European financial centres, Tom. And we're really trying to, I guess, highlight the difference between the UK and the rest.
This policy is Labour proactive as well as Tory proactive.
Tom, I'm with you. But you know what politics is like. The politics, the policy will be spun pretty quickly.
McKee's like, why did I show up for this discussion? Joining us in New York, Michael McKee, in charge of Bloomberg Economics and Retail Sales Theory, and we're thrilled he could join us today. Michael, I'm sorry to go on like that with John. Very quickly here, retail sales includes inflation, right? Is it a good study this morning if it's inflation affected?
We're going to have to adjust for that mentally. The problem is it's not adjusted for inflation, but each category would be adjusted separately. So at this point, it's not going to be an easy task, but we can get a rough idea. And at this point, when inflation is running at about 8%, you can take slash about 8% off of your costs there. I did just talk to the boss, Tom, and he said, you pieces of meat over in London, since you're in London, are going to have your salaries cut.
Thank you, Mike. I appreciate it, and thank you for being with us. Now, I'll let you stay for another question. There is a question about retail sales and whether we get a sense of how much people are diverting money away from the gasoline bills that they had previously been spending. Now that they're saving a little bit more compared to where they were, let's say, a month ago, are they putting it more to services? Is that just increasing spending elsewhere? How much of a reading will we get on that today?
We don't get a huge reading on goods versus services because the only services in this report are bars and restaurants. It'll be interesting to see if that picked up at all. Of course, it is during the summertime when people are more likely to want to sit outside and maybe have a pint here in the U.S. But the question of whether they diverted money that they would have spent on gasoline is going to be an interesting one and not necessarily a clear-cut one because it's also back to school time. So we may see a rise in, say, department stores, general merchandise stores, apparel, that is going to be hard to separate out from where the money came from. But we also see that people still have big checking accounts, big money in the bank, and they've been using their credit cards more. So they've been making up for the gasoline prices, or have they been spending some of the money that they weren't spending on gas? So not an easy read on that today.
Mike McKee, thank you, sir. I'm sorry for having a go at John. Should be the small print at the end of the show every day, Tom, just on the screen. Don't you think? I think so.
I'm sorry.
I think so. I'm sorry. Or maybe we should just apologise for the
The
whole
reason
thing.
the compensation thing, John's a big deal, like when you took your place in Knightsbridge, 4 bedrooms, it was really nice.
Sure.
A hitter like you
Sure.
redoes the kitchen. If you redo the kitchen, it helps labor.
Tom, we're on the same page.
Are we?
I agree with
Okay,
you.
fine.
I'm just saying that once
You've never invited me over
once
to
you
the place.
introduce a policy like that at a time like this, the newspapers start looking like the newspapers would look, as Lisa pointed out. That's all.
You're like 4 blocks from Harrods towards the Ivy restaurant,
I've
right?
lived in New
Yeah,
York for a long time, Tom.
Okay. Just wanted to
You're
share.
well aware since we're next to each other every day. Anyway, I digress. Let's finish with this, just to wind you up a little bit more. Is bad news today? Is good news bad
Seriously,
news?
come on. What are you doing?
Come on,
we
I
don't
just
need
want to go
anything
there.
more.
When I leave in 6 minutes.
I know, so exactly. You're going to wind us up.
I
and
might
then
not get back for
peace
retail
out.
sales, but is good news bad news, and is bad news bad news?
Bad news is bad news at
And
this
good
point.
news?
Good news is bad news, too.
Isn't that problematic for anyone
But
looking to
that's
get long
true.
this equity market? We're down 0.2% again. There are some people who truly believe what you just said.
I mean, if you get bad news, right, if you get something that signals that you're getting more of a slowdown, then that goes to the earnings and that goes to the profits coming down, right? I mean, at what point do you get back to this Fed put idea that if they pause or if they lower rates, A, that they're going to do that when they're saying we're absolutely not going to do that, and B, that that's going to help support equity markets if the pain is that deep?
So if it's bad, they've got to keep hiking anyway, and if it's good, they've got to hike a little bit more.
Exactly. That's basically the way that it's being priced out.
That's the situation right now for markets, Tom. That's incredibly difficult. Futures, Tom, down 0.2.
Bloomberg Financial Conditions Index, negative 0.20 standard deviations. That's nowhere near where Chairman Powell wants it, and that's because of the power of corporations, the consumption spirit on a higher nominal GDP, which is what we're seeing, and I believe will sustain somewhat.
Do we have to crush that to get inflation back to 2%?
There's a school of thought that believes you have to crush that. That's the correct language.
Do you know what I can
Yes.
see? I can see Jeff Yu of BNY Mellon. He's in the building, Tom. That's very
I can't
cool.
see that.
That
can
is
see it
an
just
awesome
around the corner.
thing.
Mrs. Keene just emailed me
What
and
did she
says,
say?
why don't we have a place in Knightsbridge? You know?
You can have mine. Pretend the place
Your
in
phantom.
Knightsbridge.
Your phantom.
Thanks,
Not
John.
this. Just to clean that up before you start sending me abuse on Twitter about having money for a place in Knightsbridge that I do not have. Futures down 0.2%.
You're off to important meetings
I'm so gone.
with the new administration, the new government here.
And the governor.
Yeah.
Live from London. I don't. That's not where I'm going. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
No doubt the Fed signaling that there is more work to be done.
They are keenly focused on price stability and reducing inflation, and that does mean, sacrificing some real growth.
It's not really about whether we're going to get 75 or 100 in September.
To bring inflation back down to 2% over 2 years, we could be looking at 3 million additional people out of a job and also deep recession.
I think investors just have to hold on to their hats right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome you to Queen Victoria Street, our studios here in London, as we move to a funeral for the Queen on Monday. We'll have all that coverage for you on Monday, but before that, yes, coverage on what is going on in London, but around the world as well. And Lisa, I think the distillate for the Bloomberg world is what we're seeing in the bond market. You've got the chart up there on the terminal. It's extraordinary, the movement in yields.
What you're seeing right now is a 2-year yield that is adjusting to a more hawkish Fed for longer. You are taking a look at the concept of all of a sudden a peak Fed funds rate, at least has priced into the market of 4.4%. Now the question is, how do you price that out in the rest of risk markets at a time when there still is enough resilience in the market to keep the Fed hiking rates?
And what's so important, I want to go into this math right now with Lisa. I can't do this with John, but I can do it with Lisa. John Farrow on assignment in the next couple hours as well. I want to talk about the Bloomberg Total Return Index with aggregates in this case, aggregates in U.S. bonds. And we have not broken down to new low price high yield, but on my moving average basis, we are at new low prices on the summation of the bond market.
Yeah.
It's a bear market.
Another way to put this, and yes, it is almost actually technically a bear market of down 20% in bonds, which is unheard of from a historical perspective. But if you take a step back, this is an entire world that has been fueled by debt, readjusting to the concept of rates that are way beyond what we had ever thought was possible in the new reality of low interest rates, low inflation, and low growth. Suddenly that's been flipped on its head. And how does the world readjust?
And what's going to be interesting here, folks, we're going to get through the brief here very quickly to get to our wonderful guest this hour. Somebody came up to me at the hotel I'm at, and they say, when are you going to have Jeff Yu on? So we're going to do that here in a minute for Global Wall Street. Thrilled to do that for you. Agreed. But what Jeff Yu is going to do is fold in currency dynamics,
which are incredibly
into
important.
equities, into bonds. And with 7 yen on CNH, it's historic this morning.
Yeah, breaking through the psychological levels as China came out and continued to withdraw liquidity from the system and did not ease rates yet again, which was a big concern. We're also seeing a little bit of a continuation of weakening in the S&P, but currency very much front and center.
Let's get on a brief right now. Lisa Bramus to get you started on a retail claims Thursday.
It is retail sales Thursday, although it's hard to know exactly how much this will change the dialogue. 8:30 a.m. we get U.S. initial jobless claims, as well as retail sales, which we were talking about, Empire Manufacturing, a whole host of other data. I want to see whether we get any view into stripping out autos, stripping out gasoline prices. What kind of spending power is this? And this really speaks to the CPI data we saw, which was services inflation really picking up. How much of an insight do we get into that? Treasury Secretary Janet Yellen today is delivering some remarks from Maryland. She'll be talking about tax code changes.
On the IRS.
On the IRS, well, with respect to the Inflation Reduction Act and what's going to be happening with that. And really, I want to hear what she has to say about the trajectory of the economy, as well as some of the latest moves by President Biden. We haven't really heard from her as much as in previous years. And today, Chinese President Xi Jinping is meeting with Russia's Vladimir Putin for the first time since the pandemic. Kind of an amazing meeting after their doubling down on their partnership, a pretty anti-United States rhetoric. How much should they actually put action behind that? And do we get any insight into zero COVID and to the war on Ukraine?
Interesting to see, to say the least. Right now, on the events of a quieter Thursday, with King Charles III resting today before a Friday, a weekend, and a funeral for his mother on Monday, we speak with Guy Johnson. Guy, still a somber mood in London.
Absolutely, a very somber mood, Tom, and that will continue, as you say, through to next Monday. The UK is paying its respects, the world is paying its respect. We're going to see many leaders gathering here in London, a logistical nightmare in some ways for the security services here, but they will manage it, and I am sure that it will go off without a hitch. Then what?
Guy,
I think is the big question here.
Yeah. Guy, we've been hearing a lot about not only that, yes, things are closed, but on the peripheries, things are still happening, and we're hearing proposals about some of the energy proposals from Liz Truss, as well as the cap on bonuses for bankers being lifted. How is that really shaping the conversations? What happens next week after the funeral?
So next week is going to be frenetic in so many ways. We are going to be building up to Monday, but I think after that, Lisa, things get really interesting for the UK. We are entering a new world, a new era for the UK. It starts, I think, on Thursday with the Bank of England. Are we going to get 75 basis points? Are we going to get 50 basis points? But I think the bigger challenge at the moment is that in some ways the monetary and the fiscal authorities are pulling in different directions, because we think on Friday we're going to get this new mini budget from Kwasi Kwarteng, the new Chancellor. He has talked about, Liz Truss has talked about this idea, Tom, that we are going to produce 2.5% growth. Setting a target's great. How do you actually achieve that target is much more difficult and much more nuanced, Tom.
I'll say for Americans, really extraordinary to see almost supply-side economics coming out of the world of Guy Johnson. Guy Johnson, thank you so much. This is a joy to have Jeffrey Yu with us, Senior EMA Market Strategist at Bank of New York Mellon, with us here at Queen Victoria Street, and more importantly for this entire half hour. Jeff Yu, I need to go to Beijing today where they note 7 yuan on CNH. I went back and looked, September of 2019, 7.19. For our listeners and viewers worldwide, what are the ramifications of yuan moving without pause up to 7, or dare I say 8 yuan per dollar?
So fundamentally, if you had any hope that Chinese demand was going to help the growth story right now, you can forget about that because, from especially emerging markets' point of view in general, have a weaker currency, reduces your spending power. That's going to be problematic. So, Chinese growth this year as a domestic and international driver, it's a write-off.
You and I studied this. How close are we to the classic race to the bottom, where with strong dollar, not near Plaza Accord levels, but how it just seems everyone's slipping away?
Well, here, Beijing's probably happy that DC is looking more at Tokyo, rather than Beijing right now. And rest of Asia is looking at Tokyo. If you look at the trade exposures, a lot of Asian central banks, they want to hike rates. You know, they're seeing high energy prices. You look at Korea, you look at Taiwan, you look at Thailand even, but they are exposed to Japan as well. You've got maybe 15-30% of their basket yen. It's a problem.
So let's talk about this. We've heard about this intervention, verbal intervention, which yesterday I had some skepticism about. They're coming out saying we could do something. We could do something anytime. We aren't going to tell you what that something is. Do you buy any of this as having legs?
So the market's now taking it a bit more seriously. If we look at our flow data, for example, I think what we're seeing is less assertiveness in dollar buying, but that doesn't mean the market's turning around and trying to buy yen at the same time, because let's be frank, we've heard this before. Ultimately, it's going to be action. So where's Ministry of Finance going to play into this? And I think we discussed this a few months ago. When's Madam Yellen going to opine on this as well? That will tip things over.
So what would happen, let's say, if aside from trying to intervene with just buying more of something or else other, just abandoning the yield curve control, abandoning some of their policies, how disruptive would that be to markets?
So the disruption, I think, to JGB market would be much more severe, compared to FX markets. FX markets have been somewhat anticipating this, maybe since 125, 130, right? So you've got a good, 20 big figure runway all the way into that. But YCC, that's been a cornerstone of Kuroda. That when you think of Kuroda, when we look at Kuroda's legacy years from now, it's going to be YCC. Is it going to be a chaotic end to YCC, or does he want to see it through? Personally, I think he wants to see it through.
And now, folks, a lesson with Jeffrey Yu. Coordinated versus non-coordinated intervention. The Bible, the Dornbush Bible, is if it's not coordinated, it doesn't work. Can Japan affect any intervention of some way unilaterally?
It's probably not going to work if they do it unilaterally. They try to do it the other way. I think they still hold the record for the biggest single-day intervention by the central bank, $120 billion worth. Was it two big figures? And it went right down here not long afterwards.
Vapored.
Coordinated, sends a message. You've got the world central banks on one side. Please try not to take them on, and people can do the math.
Let's bring it over to strong dollar. The former president, Mr. Trump, would be daily on television saying this is un-American, this is not the way to go. We're clearly through the Trumpian rage to some new level of strong dollar. Should President Biden be outraged over where dollar is?
I think at this point, going back to the Rubenesque, almost view of benign neglect, I think that is probably the best way to
this
look
is
at
the
it.
Secretary Treasury, not the art dude from the
Thank you. I appreciate it. I was familiar.
And looking at it from the Fed's point of view, because if you start to push back into strong dollar, you're effectively saying the Fed should be hiking rates as aggressively. That is a problem in itself.
Well, Jeff, you of BNY Mellon, stick with us. We're going to be having you for the next segment, but I got to tell you that, Tom, this really is at the heart of the issue with respect to the Japanese peg and what would happen if they are forced to do something about it. We have not really contemplated the market disruption in
But there's others out there, including EM as well. I would suggest, Lisa, that it is the litmus paper. The system, the world of Jeff Yu is something everybody has to follow, even if sometimes we have no clue what Jeff Yu's talking about.
Well, and it's slipping my mind, but there was a guest who said that one of the many things that would have to come together to get 5% 10-year yields would be Japan abandoning the yield curve control. And so people haven't really considered the ramifications, the ripple effects of damage.
Right.
And a lot of people are saying, well, they're not going to do that, as Jeff was just saying. He wants this to be a linchpin. But then what happens to the yen? How much can they actually intervene to make it stronger in the wake of, in the face of a 100 basis point rate hike or 75 basis point rate
Rachel
hike?
from Indiana, thank you so much for watching today. She says, I don't care about the Pacific Rim. Just tell me how much my plane ticket's going to cost to London. So we have to come back and talk about sterling. It's weaker. It's demonstrably weaker.
It's demonstrably weaker, and the euro as well, which has been also.
We'll continue this discussion from London here, and we will be here through the Monday services for the Queen of England, a huge anticipated gathering of world leaders. In the 8 o'clock hour, Jim Paulson, Luthold, good morning.
Keeping up to date with the news from around the world, with the first word, I'm Angel Feliciano. There's a tentative deal to avert what could have been a damaging railroad strike in the U.S. The Labor Department says that the railroad companies and unions representing more than 100,000 workers came to an agreement after 20 straight hours of negotiations. The government says the deal, quote, balances the needs of workers, businesses, and other nations' economy. The Biden administration today will unveil some of the planned changes for the Internal Revenue Service. They include efforts to dramatically bolster the capacity of in-person and call-in support services. Congress approved $80 billion in new funding for the tax collection agency in legislation passed last month. The leaders of Russia and China meet today in Uzbekistan for the first time since the invasion of Ukraine. Shortly before the attack in February, Vladimir Putin and Xi Jinping declared a no-limits friendship. Still, after suffering humiliating losses on the battlefield, Putin shouldn't expect much help from Xi. China has resisted sending military supplies or financial support. The British government may do away with a cap on banker bonuses. It's a controversial move that underlines the new government's determination to introduce major post-Brexit reforms to the City of London. The EU imposed the cap after the 2008 financial crisis. It limits bankers' bonuses to 2 times their salary. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
American manufacturing is roaring back. Just since I've been in office, we've already created 10 million new jobs. Unemployment rate is 3.7%, near a 50% low, a 50-year low. But there's more we can do. But the American people should have confidence that we are on the right track.
The President of the United States fired up and certainly been fired up in the last 10 days or so. We welcome all of you to Queen Victoria Street in London, our continuing coverage of the services in the moment for Queen Elizabeth, looking to the funeral here on Monday. I do want to point out, as the President mentions, an unemployment statistic under 4%. And Lisa Bramwitz, that's a key theme to speak to Richard Clarida about on Fed Day.
Basically, is it too low to achieve what the Fed wants to achieve, which is not a conversation that is comfortable for any policymaker, because nobody wants to see people go out of work. We're also seeing the strength in the dollar, and we continue to see that. We're now back under parity for the euro at 99.77. And we still have with us Jeff Yu, Senior EMEA market strategist at Bank of New York Mellon. And I wanted to talk to you about that, because we were speaking with Namiro's Jordan Rochester earlier. He sees a 90 for the euro as very plausible. Do you agree?
I'll be on the other side of that, actually. If we look at our custodian data right now, so we are now basically more short euros, our clients, compared to the Eurozone debt crisis and nearly at global financial crisis levels. Are we really seeing European banks falling over each other every other day? Are we really talking about existential risk, Eurozone breakup, things like that? Already fiscal impulses coming in, talking about windfall taxes. There is a plan here, TPI, OMT, that probably never even need to be deployed. So I don't think we're there.
So this is really important. Are you basically saying we have seen the weakest levels for the euro versus the dollar, and it can only strengthen from here?
I would say it's very difficult. The bar is very high for it to weaken from here. I don't need it to strengthen aggressively higher back to fair value, say 110 or 150, anything like that. But so we only need to get to maybe like half as short as where we are right now in terms of positioning, and I think that's more than adequate. And if you look at the ECB itself, its forecast revisions were actually towards the benign side. So I don't think things are that bad from their point of view. Yeah.
I want to do a window into Jeff Yu research, because you and the high gone at granularity, nation to nation. It's been your hallmark for years. And I want to go to something you said here when we were going back and forth in the break. And you look at Mr. Kuroda, and Lisa's talking big figure Bank of Japan, Ministry of Finance numbers, and you go down to, I've got it here, Chuka Soba Tomita Ramen in Japan. You take the actions of the governor of the Bank of Japan down to a pack of ramen in Tokyo. How do you do that?
Well, so I hope our Japanese viewers correct me if I'm wrong, but I believe you can still get a bowl of ramen for 390 yen. So you take a 500 yen coin, you can still buy a bowl of ramen, good quality ramen. At some point, if you can't do that anymore, people will notice it. People in Japan are already noticing it. And Kuroda had to apologize for that. So on the one hand, it's going to be domestic pressure that will push the BOJ at the end of the day, and Madam Yellen on the phone to a counterpart in Tokyo. So that's where YC SEC potentially will need to crack.
I wanted to get there. I knew the answer you were going to give me, and it's precisely correct. Are we going to see the same domestic pressure, say, in London and across all of the United Kingdom with a 114, 113 sterling?
I think people here are feeling it already. If you look at real wages, that's being beaten down, and it's quite a good correlation with spending, for example. So one of our supermarkets this week have basically limited the amount of cheap item goods that people can buy, because people are starting to hoard such items. So people are feeling it already, but more of a market mechanism here. Japan might be a bit different.
I can't emphasize enough, Lisa, how this analysis is so important. We talk about FX in the Bloomberg world like fancy people moving on $1 million. It's a pack of ramen in Tokyo.
It's a pack of ramen. It's going to the grocery store. Jeff was also talking about how they set their prices, and they're going to reset them at the end of the month. And if they set them much higher, people will feel it, and they are feeling it all around the world. The response politically has been to make markets a little less free markets, and we have seen that consistently. You could argue that JGBs are no longer a market. They do not trade. How do you, as a market participant, factor in these sort of anti-market practices that are increasingly adopted by policymakers who find the market inconvenient right now?
Well, you can only go for the least bad option, so to speak. Let's look at the energy cap in the UK. It was an anti-market framework, the energy price cap, to begin with, heading into this crisis. And as we know right now, well, assuming they implement those factors, basically energy suppliers are going to be able to cap energy price, so not pass on potential energy price declines on the way out to claw back some of the cost. You're anti-market on the way in, anti-market on the way out. What's the point?
We begin our coverage right now of a Fed meeting on Wednesday. We do that with Jeff Ryu of BNY Mellon on radio and TV. Clarida, Gertler, DSGE. You and I know the math of dynamic stochastic general equilibrium theory. I would suggest, Jeff, to the former vice chairman and everyone at the Fed, all that fancy talk is out the window. What is someone like Clarida worried about in behavioral monetary theory, not the mathy monetary theory?
From a behavioral point of view, how do you condition the household? How do you condition the business to adapt to this new anti-market reality, as we are talking about? Because if that framework no longer works, those automatic adjustment mechanisms and that legendary theory, rational expectations. How can you have rational expectations?
Don't get me going.
Right. Exactly.
You have no idea.
How can you be rational when the people setting the policies, you don't see that as rational right now?
Lucas was so angry at me once the foam was coming out of his mouth, Jeff, talking about this.
Well, so just to sort of put a bow on this, 100 basis point rate hike off the table?
I don't think it's off the table. I think anything's off the table right now. But if I had to pick one 100 basis point, who has the higher chance of that next week? It's not the Fed. It's probably the SNB.
Really?
The Swiss National Bank. So
that's fascinating.
They are going to go positive, finally, and there are some wobbles. So finally, because they have shown in June they're willing to go way ahead of the ECB. Your old expectations out the window. They want a strong franc. They can sell reserves to support the franc. They want an outright strong franc to bring down inflation.
If they get convexity on strong Swiss franc, how does it play to their trading relationships and wealth relationships with Europe?
Oh, those are two very separate.
Let me cut to the chase here, and don't get your general counsel involved. What's it do to Credit Suisse's share price?
I think, well, that's more of an interest rate view, but I think still financial services companies, they will like that in Switzerland. With my prior wealth management hat on, it makes the discretionary model much more viable. So I think net wealth managers, they can maybe go back to the good old days and think about that.
He's the only guy in the world that can answer that question and not get fired.
Well, Jeff Yu, it is a pleasure having you. Thank you so much for taking the time. We really appreciate it.
We're going to continue here. There's just much more to talk about. A set of eclectic views and wonderfully qualified as well. Coming up, the gentleman from the Dartmouth bubble. We're thrilled that David Blanchflower, yes, with his relationships to the Bank of England. David Blanchflower on Cardiff football. David Blanchflower on a weak sterling. Good morning from London.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Bloomberg Surveillance this week from London with our wonderful team. Qantas came over with us and has been really great at herding the cats here to get this done every day. We will continue strong through the week. I will be here Monday for the funeral of the Queen. Honored to do that with Anna Edwards and with our David Merritt. Lisa and John will head back to really get prepared for a Fed meeting. And Lisa, we were talking about James Taylor, fire and rain. Liz Ann Saunders brought up traffic as well. And there was a trio back then that was outstanding. Stiglitz, Blanchflower, and Powell were outstanding folk trio. Wow, are they far apart in this Fed debate?
So who is the singer of the 3?
I think Blanchflower. He had the Welshian thing going as well.
They are absolutely a mile apart because they are basically arguing there is no need to double down on rate hikes. In fact, keep it where it is or even go further. And even some people have proposed, I think Danny is one of them, cutting rates. But the idea here is this concern that the Fed will stymie economic activity at a time when it's already deteriorating. And it is a real debate.
It's a real debate, and it folds into the market check as well. The market check this morning is very subtle. We're waiting for retail sales out an hour and 10 minutes. A lot of other data today that Michael McKee will bring us. Kathy Butchonsek scheduled to be with us as well. But what's important here are the nuances. Lisa, I'm going to go to weak sterling, second time down. That gets my attention. What are you looking at in the market?
Well, I think that the big news of this morning, currency-wise, was the Chinese yuan hitting that 7 level that is a psychological breach of weakness versus the dollar, but really continues to be the 2-year yields. That has set the tone as people have reset their understanding of just how far the Fed is willing to go and for how long and how much momentum is in the economy to allow them to do that.
Joining us right now, a member of Stiglitz, Blanchflower, and Powell. He retired from the folk circuit. David Blanchflower joins us, professor of economics at Dartmouth College, and of course, formerly with the Bank of England as well. Professor Blanchflower, thank you so much for joining us. The basic idea is a public official, Jerome Powell, Joe Stiglitz, and Dean Baker write it up. They're wrong, wrong, wrong. And you're nuanced. You don't have the view of Stiglitz, don't raise rates. There's more to it. Describe your stance here.
Well, a couple of things. I was looking at GDP growth yesterday, and since 1991, there have only been a few periods that have been negative growth. All of them, every one of them, has been as part of a thing where the NBR is called recession. 2001, 2008, 2020, this is the 4th one. The US appears to be in recession, and the NBR is likely to call recession at the start of the year. The UK is probably in recession now too. Also, in 2008, inflation in August 2008 was 5.6%. By August 2009, it was -2%. We've had 2 months of zeros on the CPI. if you get that continuing forward, you'll actually get to 0.3% inflation by next June, with every expectation that the number will be lower.
Right.
So my view is that actually you're in a recession. The likelihood is that inflation is actually tumbling very fast. And in those circumstances, forget the rhetoric, you would actually be cutting rates. Right. And the other one, if you look at the Bank of England's forecast, the Bank of England is forecasting in the UK that in 2024, there's a 55% probability of being below 1 and a 25% probability of being negative. So the reality is that what are people looking at? The expectation is that inflation is about to...
Well, David,
and we're in recession.
What we're looking at, and we're all working off of, are models from another time. And whether it's stochastic moves in inflation twice from 47 to 52, or it's Volcker 79 to 81, whatever anyone's model is or belief, can we utilize those models given the multiple huge impulses of a pandemic?
Well, Tom, that's a fantastic question. I teach a class at Dartmouth called Pandemics and Financial Crises. And I think the story you have to look at is Great War, followed by a pandemic, excuse me, followed by a financial crisis, and then deflation and high unemployment. What have we seen in the last dozen years? Financial crash, pandemic, war. So that's the reality. Anything since 1945 tells you nothing about how the world is. Central banks weren't negative. They weren't doing QE. Perhaps the reality is that we have to look back at the period where there was crash, pandemic. We've had crash, pandemic, supply shocks, earthquakes. We have hurricanes come into Florida, which causes the shock to the housing market. So the reality is that we should look at history. And in fact, the class has been actually looking at the history of inflation, what happened after the Black Death, what happened after the eruption of volcanoes. That may be the model you need to look at.
With all due respect, a lot of people are looking at their grocery bills. A lot of people are looking at their rents. A lot of people are looking at how much it costs to go on a trip and stay in a hotel or go on a plane. And these are the things that are the anecdotal notes that are not saying that inflation is slowing down and that next year it won't either, because people are still spending on these items. So what is your concern? How high of an inflation rate would you be able to tolerate over 5 years, let's say, that would allow you to say, look, even if it only gets down to 4%, we're still winning?
Well, the reason we have inflation the last 2 months has been no inflation. So everything's been driven by base effects. And as we move forward, the large base effects drop out first. No one denies, second, that inflation hurts people. But the evidence is, I've written about it and new papers are coming out now, a 1 percentage point rise in unemployment increases pain by 10 times more than a 1 percentage point rise in inflation, partly for the reason I just told you, that inflation plummets. We're going to see it plummet to probably zero within 9 or 10 months, my guess would be, unless there's another war, unless there's another wave of the pandemic. So the reality is that inflation disappears, unemployment doesn't. So you're creating a situation which is worse. So yes, it's true that inflation hurts people. The question is the solution that you're creating worse? And the answer is undoubtedly that's true. So it takes much longer to get rid of unemployment. Unemployment hurts the unemployed and hurts everybody. Despite what the rhetoric says, all the evidence is completely wrong.
There are a lot of people who say that unemployment is not a goal, but it may be a necessary side effect, and just that it would rise a little bit being the key. And those are the projections that we're seeing from the Fed, that there's slack in the market. People who have savings, who have not gone back into the labor market, gotten jobs because they don't have to. How do you push back against that and say that this labor market is not nearly as tight as people think, and that the unemployment rate could rise much more considerably than they're certainly counting on?
Well, let's go back. If you go back to September 2008, the same discussion was going on. The Fed said, all you care about is inflation. We don't think a recession's coming. Actually, the unemployment rate then, well, it went to deflation in 2009, I told you. Unemployment went to 10%. After they said that nothing was coming, there was no recession. So the reality is these people missed the Great Recession. So how can we trust them? The reality is that unemployment is going to rise. And if you look at the labor market, the employment rate is about 7 million jobs below where it was in 2000. So I take a completely contrary view to that, but you shouldn't trust what the Fed says. They missed it last time. They said it was all about inflation last time, and it wasn't. And unemployment went to 10%, which is every expectation. It will do the same, caused by the Fed and the conversations you've been having with everybody.
With us, folks, David Blanchflower of Dartmouth College on Bloomberg Radio and Bloomberg Television. And David, that course you studied, I think you taught 10 years ago at Dartmouth, Blanchflower on supply-side economics. I think 4 people signed up for the course. Tell me about Trussian's supply-side economics. Tell me about the growth theory.
Well, my classes are waitlisted these days. I have to tell you, I've got people out in the gazoo trying to come to them. Well, I think the reality is pretty interesting. I've written endlessly about trusts in the sense that the things that they've written about, which is improve the supply side, go for growth, change the remit of the Bank of England, do tax cuts and corporation tax cuts. Well, that's all very well. None of it's going to have an effect on the ordinary person who can't pay their bills. And that's how the reality is going to hit. All we've heard is an announcement in the last couple of days, fire the boss of the Treasury and raise the cap on bankers' bonuses. Well, this is going to be the only anti-populist government you've ever seen, because reality hits this week as bills come and people can't pay, and as pubs close. So the supply side is all very well, but the same people have been in power for a dozen years. So the reality is that what are you going to do by Christmas? And I've heard zero.
I've observed a Blanchflower lecture, folks, and it's quite something to see the aisles absolutely jammed at Dartmouth, and Douglas Irwin, the giant of trade, sitting in the front row, intimidating, to say the least. Danny, thank you so much. Next time, Carter Football. He is with Dartmouth College.
Thank you so
There's
much,
a
Danny.
lot there, Lisa, to unpack. What did you hear?
What I heard was this fear of the wrong symmetry of risk, an asymmetry of risk that we talk about, right? And this is something that Jay Powell has talked about, that the asymmetry of risk to runaway inflation is more perilous than potentially stymieing the economy. And what Danny was saying is that that's wrong, and that there's actually a greater fear of the unemployment rate going high enough that it would not come back down and cause more permanent scarring. And that, to me, is the debate underpinning a lot of this discussion.
And to me, and this goes to the jobs report that we'll see here first week of October, I believe. Are we back in New York by then?
I think we are.
We are. We're back there.
You're planning to stay for a month?
Maybe not, if we keep it going.
Yeah, you're going to try.
Keep it going here. But I think what's so important here, it's the elephant in the room, that the labor market hasn't moved, and they have to wait for that.
And they don't understand. This is the big misunderstanding in markets right now. How tight is the labor market? Because a lot of anecdotal evidence would suggest very, and yet what Danny Blanchflower is saying is not really. And this is really the question mark of the data and the integrity post-pandemic.
My financial headline here from the Wall Street Journal a number of days ago is how Amazon is raising compensation for delivery drivers into the holiday season. Lisa Bramwitz and Tom King. John Farrow on assignment on this Thursday. Coming up, we have claims, very important. Coming up, we have retail sales, maybe more important. But coming up, and vitally important, Michael McKee will join us. That's a good thing. From London, this is Bloomberg. Good morning.
Keeping up to date with the news from around the world, with the first word, I'm Angel Feliciano. A marathon bargaining session has led to a tentative agreement that to avert a railroad strike in the U.S. The Labor Department says that after 20 hours of talks, railroad companies and unions representing more than 100,000 workers reached a deal. A strike would have frozen critical infrastructure that transports about 40% of all long-haul cargo in the U.S. Ukraine is solidifying control over territory its troops have retaken from the Russians. That's according to President Vladimir Zelensky. He meets with troops in Izium, the biggest city recaptured last week. Ukraine's general staff says Russia is again targeting civilian infrastructure. Top executives from about 20 leading global firms have committed to flying in for Hong Kong's financial summit in November. Bloomberg's learned that CEOs at Morgan Stanley and Citigroup are prepared to come. Attendance by many of Wall Street's chief is still contingent on Hong Kong ending its 3-day quarantine for incoming travelers. And in China, economic growth has slowed so sharply that several major banks don't even think a 3% increase is achievable. Projections have come down steadily since March, and the consensus in a Bloomberg survey is for the Chinese economy to expand 3.5% this year, the second weakest in more than 4 decades. The official data for August comes out Friday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and the electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Starting to see some easing of goods inflation, and more should come given what you've seen from container costs coming down, supply chain issues easing. But the demand side, there's still a lot of inflation there.
Michelle Meyer with an exceptionally important set of comments on her wheelhouse, which is housing dynamics in America. I really can't say enough about that. Go back and listen to Michelle Meyer on our digital product on YouTube and such. She's just expert on rental and homeownership housing. And Lisa, what we heard from Michelle Meyer, just very simple, was the consumer is there. They haven't walked away yet.
No, and she has a front seat view on that, given all the flows with MasterCard and the data there. But with housing, they're also not walking away, which is the reason why rents continue to go up, despite some of the higher rates.
We welcome all of you. Jonathan Farrow on assignment today, Lisa Bramwitz and Tom Keene on radio, on television through the week, and on to the funeral that we will see of the Queen of England. We will see that on Monday. Anna Edwards and I, with David Merritt, will have coverage of that. Right now, a turn to the market, some interest in foreign exchange, some interest in bonds, but also, the truth is, over a beverage of our choice last night, Lisa Bramwitz had a complete tantrum and said, if we don't talk credit tomorrow, she's going to get on the next plane out of Heathrow. Why don't you bring in our esteemed guest?
I wish that were true. That would be very fun if that were. Danielle Foley, we really are pleased to have you with us, co-portfolio manager at Oaktree Diversified Income Fund. And perhaps I should have had a tantrum yesterday because we were having all of these fabulous, debates on set between people who think that credit is pricing in some sort of downturn and others saying not even close, that there needs to be a lot more work done. Danielle, I'd love your view of where we are, what we're pricing in, and a sense of how far people have kind of reset their expectations.
Well, thanks so much, Lisa. I appreciate you and Tom having me join you. I wish I was a part of those conversations because I'm a bond geek just like you, and I have got to say that credit looks as attractive to me as it has in many, many years. In fact, I see an opportunity today to get equity-like returns in fixed income markets.
Okay, can you elaborate on exactly where? That's a pretty bold statement. In other words, 10% returns plus in credit.
Yeah, that's right. You know, our Oaktree Diversified Income Fund, ticker ODIDX, right now has an average yield of over 10%. And the way we allocate that fund is into our highest conviction opportunities across Oaktree's performing credit platform. That's in both public and private markets. Today, about 75% of our fund is in performing, stable, high-income generating private credit, and then the other remainder in public liquid market securities that have dislocated, mostly driven by rates, and are now approaching yields similar to private credit.
Whenever someone can promise equity-like returns, the warning bells start going off. What kind of risk are you taking at a time when there is so much uncertainty and you're getting rate hikes not similar to anything we've seen in decades? How do you sort of gauge what risk is appropriate to take?
Yeah, we're always focused on risk. That is a tenet of our core investment philosophy that our founder, Howard Marks, penned over 25 years ago. And our approach at Oaktree is focused on bottom-up fundamentals of the companies that we lend to. I think unquestionably fundamentals for the broader economy have weakened. There is a reduction in stimulus, quantitative easing has ended, and we are seeing rates higher. And this creates a very challenging market for credit, but the quality of the credit market is much better than it was, heading into COVID, especially the high yield market. And so we are thinking that defaults are going to be lower than expected by most in this next economic cycle.
Yeah, that's right where I wanted to go. Danielle, this is really important. It goes to you have to have a really sharp Dixon Ticonderoga when you're intimidated by Howard Marks. One of Howard Marks' heroes and mine is Daniel Fuss of Loomis Sales, who constructed bond total return as an act of God by credit upgrade. Are you suggesting off of Dan Fuss's seminal work that we're going to see bond market total return completely outside the zeitgeist because of credit quality upgrade?
I hate to forecast anything because no one knows. I think the best that we can do is pick high-quality companies that are, offering us attractive income and hold those for the long term. We really are trying to construct a portfolio that's agnostic to market movements, but we see value today, and so we are incrementally
Is it agnostic to credit movement? I get that. You sound like the wrapper on a prospectus from 20 years ago. Danielle, are you betting that we will see credit quality improvement?
No, I'm not, Tom. I think that we have seen some fundamentals weaken. And while income has risen, for example, in the senior loan market, income's a double-edged sword. That increases the interest burden that these companies have. And the senior loan market, as compared to high-yield bonds, for example, is not as strong of a market from a quality perspective. And so it's really important to prioritize credit selection. I think broadly, credit will see some downgrades. But if you can really focus on individual companies and credits, there's an opportunity there to be had.
How do you get scale, Danielle, when you're investing in individual opportunities?
Really good question.
Yeah. You know, we in public markets have a very large toolkit at our disposal. So we invest across not only high yield and syndicated loans, but in more niche areas like convertibles, emerging markets, structured credit in particular, both real estate and corporate assets, CLOs, an area we think is very attractive. You know, on the private side, it's a combination of directly sourcing and negotiating loans with private borrowers, and we have a very deep bench of talent at Oaktree that does that, and then also working with equity sponsors where we have strong relationships in leveraged buyouts.
Yeah, thanks so much. Danielle Poley with us with Oaktree. A nice walkthrough there on the challenges of actually managing money, not being a strategist and guessing and gaming the market, but you've got money at risk. What I couldn't get out of her, and this is important, is no one is looking, Lisa, no one is looking for a credit improvement right now, and that's how you pop that total return out of the giant Dan Fuss.
In fairness, the reason why you couldn't get it out of her is because Howard Marks prides himself on not making market calls, and he is the founder of Oaktree. So what he's trying to do is measure the risks and understand what risks are being mispriced in markets. And basically, this has been an argument that a lot of people have been saying, that certain credits, certain names, certain stocks have been thrown out with the bathwater, right? The question is, how much does that get thrown out if there is some sort of exogenous shock? But it is such a difficult moment to invest in, and I think that that's the takeaway.
Let's do a data check right now. Help me out here, Lisa. We're flying by. I mean, I got Dow futures down a little bit. I got to say that because Farrell's not
exactly.
here. The VIX hasn't popped out to 27 level, so it's, you know, off of the reset that we saw off the last economic data. We've had 2 days of quiescent markets waiting for what we're going to see here in 35 minutes.
Yeah, waiting for Godot, it feels like, because it's hard to see what could actually shake the markets in the same kind of way that the CPI does, unless Fed Chair Jay Powell does come out with a tattoo of a hawk on his arm and a hawk on his shoulder, screaming like a hawk, because other than his speech, I'm not sure what else he could do.
Godot's great. He's through level 2 CFA. He's looking to take level 3 here, I think, at the December test.
Existential.
Coming up, Jim Paulson will join us, Chief Investment Strategist, Luthor Group, and far more. We'll continue to monitor markets into Michael McKee and that important economic data. From London, stay with us. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
The consumer's healthy. There's strong balance sheets. The consumer's still out there spending, and they're navigating this inflation environment.
The core part of inflation is proving to be sticky and persistent.
We're already seeing a reduction in forecasts.
Earnings expectations, growth expectations will be proved to be way to be bullish.
In the grand scheme of things, the Fed strategy and the domestic inflation story here dominates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Countdown to retail sales. Good afternoon. Good afternoon. If I'm going to do the two-word open here, this is London. I don't have a British accent. Good morning. This is Bloomberg Surveillance on Bloomberg TV and radio. John Farrow, Lisa Abramowitz, and Tom Keene. John Farrow off. Tom Keene very much here with us. John is off on an assignment. I am looking right now toward retail sales to figure out whether we get a confirmation of the robustness of the economy that's going to lead the Fed to be more hawkish.
I'm going to call it the Glassman-Meyer report. Jim Glassman at J.P. Morgan and Michelle Meyer at MasterCard on the same page. Here is the data. Here's what we see, and what it says is a buoyant American consumer. How many people push against that?
Well, pushing against it, not that it's buoyancy that they're seeing, but what the Fed has to do to get inflation under control, given that consumers aren't getting the message that they need to stop spending so much. And I think that that's the sort of good news is bad news thing that makes us all kind of roll our eyes.
I mean, to me, it's not a behavioral aspect. They have one exact tool. McKee will talk about this up to Wednesday when we speak with Richard Clarida, the former vice chairman of the Fed. And they don't have a behavioral construct here. They have a simple tool. And to your point, a la what Jordan Rochester said earlier this morning, the Titan from Nomura, 100 beeps isn't out of the realm. I can't get there. I don't see a stick. It's called a stick, folks. You're raising a stick. We haven't seen that in our known lives, I would suggest.
And a lot of people sort of discount the 30% chance that the market is given that. Right. That's Michael Feroli over at J.P. Morgan. What people are looking at is not just 75 basis points next week or 100. They're looking at the possibility that rates could go up to 4.4% as a base case, which is what we're seeing priced into the market right now.
This is important. Life goes on. Out moments ago, Adobe, we all know them, the PDF people and all that, they're going to buy Figma for $20 gazillion cash and stock. It's a Figma of my imagination. I have no idea what Figma is. What I know is this signals, Lisa, life goes on.
And to your point, Tom, capital markets are reopening after having been closed for the bulk of earlier this year, and that is notable, especially when you've got S&P futures here that are down 0.25%. You have this sort of sustained softening that we saw a couple of days ago.
You do the data check. You do it better than me, but the bottom line, I'm going to start with sterling under a 1.15 again. If I'm the Prime Minister of the United Kingdom mourning this queen, celebrating this new king, I'm sorry, I got one eye on the Bloomberg, and the answer is sterling weaker.
And they have also another eye on their energy policy that they have to come out with some more details on next week after just proposing one of the biggest fiscal plans. We're also seeing a 10-year yield that is getting higher, price down, yield up 3.45%, but I'm really watching the 2-year yield having broken through 380 and sustained there in this feeling of how far the Fed could potentially go.
You know, before we get to Jim, we're not on the 4% watch yet in the 2-year. I mean, we got to get to 390 to play that game, right?
I think that you can play whatever game you want. What we are seeing is the velocity of that yield rise and what it infers. I think that that's important to note. Right now, the question that I have is ultimately what kind of earnings pain has to come along with a 4%, 4.5% benchmark Fed funds rate. And Jim Paulson, Chief Investment Strategist at Luthold Group, has been parsing through this, someone who has been concerned about the ramifications of tighter Fed policy. Jim, what is your view on whether the market is adequately grappling with the likelihood, the probability, if you view markets pricing as such, of 4.4% Fed funds rates next year?
I think 4.4%, Lisa, is not in the market. I don't think it is. And I think that'd be way overdoing it. And I think the risk is now that the Fed does overdo this. I think much of the free bond market is pretty good. I mean, the 10-year yield's been good for months, really since May at this 3 to 3.5 area.
Connection lost.
Probably quits at the 3.25. It doesn't look like that at the moment. But I think that if the Fed's going to manage monetary policy on the basis of what was the hottest report in the last 30 days, I think they're going to make a big mistake. To me, there's a lot of contractionary force from past economic policies already in the pipeline that have lagged effects on the economy and on inflation in particular, that are going to continue to put downward pressure on inflation well into next spring, if the Fed would do nothing from here. A tremendous drop in money growth and fiscal juice, a big rise in the dollar, massive rises in bond yields, all of that still working the way through the pipe, putting downward pressure. I think the Fed's going to lose its case to keep raising rates. Maybe sooner than we think. I think that this data is going to hit inflation in a bigger way. Yeah.
There's a lot here, and we have to start unpacking some of it. We could talk about rejecting the idea of their pivot, even though they're saying we're not going to pivot. But there's also this question of what would be the ramifications if the market's right, if the Fed funds rate does get to 4.4% next year. How much downside could there be in equities?
Well, I think that I think that something would blow between by the time we got there and would cause things to stop. And quite frankly, if we stop the tightening of interest rates, I think the market would probably come out of that okay. Earnings would come off much more than we currently think, but I think multiples would expand is kind of where I'm at. If I could just point out that for an equity investor, when I look back, Tom, all the way to 1940, we've had 7 major inflationary peaks. And what I define major is over 6%. And of those 7, the stock market bottomed almost coincidentally with the annual peak in inflation in every one but one of them. And it isn't about how fast inflation comes down. It's more when it peaks. And it doesn't escape my attention that the CPI inflation rate peaked in June, and right now the market low is June. And I'm not so sure that it isn't already working its way back up.
Jim Paulson, for those of you on Bloomberg Radio, we are honored to have the backdrop of St. Paul's Cathedral here at Queen Victoria Street. And as Jim knows, the last time the Minnesota Twins won was when they were topping out the dome in 1710 with Christopher Wren. I would suggest, Jim, even more so, that if you go back to 1710 in Queen Anne, you're going to find a gloom permeates and the system fixes it. Explain how the corporate system and the economic process, Adam Smith's microsystem, solves an inflation conundrum.
Well, I think you're exactly right, Tom. I think everyone thinks that the Fed is the only thing standing between us and runaway inflation. It just isn't true. I mean, the money supply has fallen from real money supply from plus 25% in March 21 to minus 3.5% today. Fiscal juice was 18.5% of GDP. It's now 4%. The dollar's risen 20% in the last year. And free market yields started to go up in 2020. So my point is there's a lot of tightening that's done not by the Fed. And fortunately, they did it a long time ago, which is why inflation is already rolling over now. If it was up to the Fed, I don't think we'd be doing anything yet on inflation front. So and don't forget, supply side is starting to show signs of improvement as well. You know, we've created a lot of jobs this year, but we've done it with a fresh new supply in the labor force, which means wage inflation hasn't been accelerating. Yeah. That's another
Jim, one final question here, Jim. This is too much optimism, Jim. Lisa's going to fall off her chair. Jim, one final question. If we could. Michelle Meyer at MasterCard, James Glassman over at J.P. Morgan, James Paulson over at Luthold Group are saying the zeitgeist is wrong, wrong, wrong. How should Chairman Powell treat a zeitgeist worried about his world versus the three of you saying, look at the consumer, look at America?
Yeah. I don't know. He's got a tough job. I agree with that. I guess I would hope that the Federal Reserve, and I'm sure they realize that there's lagged effects of these other policies, and I don't think you keep raising rates up to the moment we get back to 2% inflation. That just makes no sense whatsoever. We're clearly have peaked inflation, I think. We're clearly coming down across a wide array of different measures, and I think at a minimum the Fed can slow down its rate hikes, and I still think, Tom, they will. And ultimately, they can create a recession if they want to, if they take rates up high enough. But I agree with Michelle and some of the others. I think the balance sheets in this country, both corporate and household, are really, really strong and highly liquid with a lot of excess buying power. And so there is a lot of staying force, but I do think that they could still create a recession if they want to.
Jim Paulson, Luthold Group in the Midwest in Minneapolis, thank you so much this morning. This goes right to our special guest on our Fed coverage on Wednesday, Richard Clarida, the former vice chairman of the reaction function, if you will, Lisa, and you get an inertial force of raising rates, whatever the parlor game is, and you have to have the courage at some point to go, I don't think so. And the question is, how far away are we from that? I don't think so.
We found a bull. We found someone who's kind of bullish. That was pretty impressive. We actually found someone.
People out there looking at this so-called catharsis with a VIX of 26. I mean, it's not as gloomy as people would suggest.
Well, they think that the Fed's not going to go as far. They don't have to, and they won't. And that, I think, is probably the big distinction here.
There's a churn here as we distinction our way to 19 minutes in important economic data as well. Euro under parity, sterling through 115. On oil, on your marginal gallon of gas, Stephen Short, next.
Keeping up to date with the news from around the world with the first word, I'm Angel Feliciano. There's a tentative deal to avert what could have been a damaging railroad strike in the U.S. The Labor Department says that railroad companies and unions representing more than 100,000 workers came to an agreement after 20 straight hours of negotiations. The government says the deal, quote, balances the needs of workers, businesses, and our nation's economy. The leaders of Russia and China are meeting today in Uzbekistan for the first time since the invasion of Ukraine. Shortly before the attack in February, Vladimir Putin and Xi Jinping declared a no-limits friendship. Still, after suffering humiliating losses on the battlefield, Putin shouldn't expect much help from Xi. China has resisted sending military supplies or financial support. The Biden administration today will unveil some of the planned changes for the Internal Revenue Service. They include efforts to dramatically bolster the capacity of in-person and call-in support services. Congress approved $80 billion in new funding for the tax collection agency in legislation passed last month. The offshore Chinese yuan dropped past the key 7 per dollar level for the first time in more than 2 years. It's a combination of a fragile Chinese economy and a strong greenback. The People's Bank of China has taken steps to strengthen the yuan, but all it's done is just slow the decline. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
No doubt the Fed signaling that there is more work to be done. The median terminal rate was 3 3/4. That probably moves higher, let's say 4 1/4 to 4.5% by the end of 23. And very likely they start to incorporate a slower economy, so higher unemployment into their forecast.
Really nuanced interview with Edward Al-Husseini, senior interest rate strategist at Columbia Threadneedle. Lisa, I thought that interview was great about the multiple dynamics as they do raise rates, whether it's 75, 50, whatever, how many times they do it. It's not a one single static analysis. There's a lot of dynamics here.
Especially the read-through effects and when it actually starts to inflict the pain that the intention is for it to inflict. I'm just watching right now the 2-year yields, and you pointed this out, Tom, 3.85%. Just that upward trajectory. You were saying we were going to play that game, the 4% game?
We're not there yet, but we're getting there fast.
When do you get there?
I don't know. We've got markets on the move. They got a beautiful chart on radio. What you need to know is curve inversion is happening at a vengeance. And this goes into a 10-minute call where Michael McKee steps up with your economic analysis. Right now joining us on oil, on jet fuel, Stephen Schork, president of the Schork Group. Stephen, we will have coverage of the funeral of Queen Elizabeth, and it is a metaphor of how hundreds of world leaders will descend on London by airplane. The United States aeroplane business is booming right now. How big is jet fuel as part of the Schork world?
Yeah, absolutely, especially here, Tom, in the Philadelphia region, where we have one of the top
Connection
jet
lost.
fuel facilities on the East Coast. So it serves both the entire I-95 corridor. So clearly, jet fuel is an extremely important component of the analysis we do, as is both natural gas, oil, and products.
What does it look like for the autumn? We're watching weaker oil prices. I believe I saw an 87 West Texas Intermediate. Bring that over to what it means for our listeners and viewers in the distillate market.
Yeah, absolutely. We're looking for a little bit of relief with regard to oil prices at these levels. Let's keep in mind high $80. That is fair value. That is a good price where both the consumer can continue to move along, and more importantly, the producer has enough incentive to go out and drill more and bring more product to the market. Tom, the problem here is with the distillate market, we're on the eve of the fall harvest. Which means that we're going to see a significant uptick in off-road diesel demand as we begin to bring in all of the crops we planted last spring. And then, of course, we transition over to the winter. Now, here in the Northeast, that winter poses a scary proposition, because when we look at distillate stocks, heating oil stocks in Pennsylvania, New Jersey, New York, all the way up through Massachusetts, we're at or near all-time lows. So we're going into this winter, as we are with the natural gas market, in a rather precarious state. It all depends on Mother Nature. If we get walloped with a cold Halloween into Thanksgiving and then into the holidays, we simply have not enough product in the market that cannot prevent prices for homeowners spiking because of the dearth of barrels we have in the market right now.
Stephen, a lot of people could paint some nightmare scenarios, but in a base case, a normal winter, based on where we are and the provisions that people have made, what kind of pricing are you expecting on some of the major oil benchmarks that you look at later this year?
Yeah, currently, Lisa, we're right now in the lull in demand. Refinery activity, both here in North America and in North Europe, your two epicenters in the Northern Hemisphere. We're going into what's called the turnaround season. This is the maintenance season. So they shut down units, they retool, they refuel, they get ready for the new fuel season. So right now we're in that lull of demand, and hence we have the pullback in crude oil prices back into that $80, that mid-80, high $80 range. And this, based on our modeling, is exactly where I expect the prices to hold for the next 2 months, that is to say. And we'll use Brent as the global market. Brent, we'll call it a round price of $90 plus minus $5. So $85 to $95 is the market's marching orders for the next 2 months. But as we transition into the holidays, jet fuel demand will pick up. Gasoline, diesel demand will pick up as we go into the holidays. And that is the next potential catalyst that gets us back and revisit oil at that $100 range.
Stephen, how much of this has anything to do with Ukraine? Has anything to do with Russia and the war that they have waged, that they appear to be backing off a little bit, at least when you look at some of the troops leaving the regions?
Well, certainly Ukraine has been a huge catalyst in prices. It hasn't been the reason. Of course, oil prices were spiking well before Russia's invasion into Ukraine. And then we kind of hit a lull. I think there was a lot of doubts over the past 4 or 5 months after initial success that, hey, can Ukraine actually pull this off? But of course, the headlines we've seen for the last week indicates that we might start to see an end to this travesty. And that's a good thing for all commodities. And certainly, Lisa, I do believe that is contributing into the psychology of this market.
Steve, you think we had John for oil and gas? We did not. The Philadelphia Phillies have been an act of God since the All-Star break. They've won 5 in a row here. They're launching above anybody. Is this the one September since time began where the Phillies don't crater?
Never say never, Tom, but if you're a betting man and you follow the trend as I do, bet against the Phils. Sorry, Philly.
There you go. Stephen Short, thank you so much for that with the short report. Lisa, I bring this up because it's the same with the Fed game, the parlor game into Wednesday or that.
That's not what
you think you got it all figured out. No, you think you got it all figured out, and the facts change.
Well,
and with the baseball and the Phillies, that's what's happened. They've been phenomenal.
You know, you're not wrong. I think that you raise actually a really important point, which is the narrative right now is uber hawkish, and you might say peak hawkish. Some
and
people
reset,
would say,
as we saw of CPI.
Correct. So what happens if we get a slew of weaker reports that show some weakness starting to bear into the data? What then is the response from the Fed? And the fact that we're trading so aggressively in all of these is pretty notable.
What's the reset in 5 minutes, 1 second?
You know, the retail reset is if there does seem to be incredible strength in spending, it will reiterate that there is plenty of momentum so the Fed can afford to be more aggressive. It will be a hawkish and not a good news kind of story.
Let's go back to what matters today. It matters in foreign exchange and that, but I think Lisa's right about the 2-year. You're speaking volumes. What's the why of the 2-year vaulting near 4%?
It's the reset from CPI. We got hotter than expected.
It's still that?
You know, people talk about a decline, and we've seen peak inflation. Yeah. But not in core. Core has continued to climb.
We begin our discussion to go to that Federal Reserve meeting on Wednesday. We are thrilled to say, I believe we will all be in New York for the Fed meeting, and with us will be the Vice Chairman, the former Vice Chairman of the Federal Reserve System, Richard Clarida of Columbia, of PIMCO. I'm thrilled he will join us. On market economics on this moment, Michael McKee next and Kathleen Bastiancic. From London, this is Bloomberg.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Jonathan Farrow, Lisa Brownson, Tom Keeney in London. Mr. Farrow on assignment this morning. Both of us wish Michael McKee was here so he could explain Richard Clarida's dynamic stochastic equilibrium theory. Instead, we'll stick with market economics with important economic data. Here's Michael McKee.
Tom, our cup runneth over with numbers this morning, so let's start running through them. Retail sales is the premier number of the day. It is up 0.3% on a headline basis, and that is much better than the 0.1% decline expected. It is better than the flat reading from last month. The ex-autos number down 0.3, so autos contributing more than people anticipated to retail sales. The control group, which is what everybody follows in the economic game, is flat at 0. Last month is revised down to just a 0.4 gain from an 0.8 gain. So this isn't a particularly great report. It is not a bad report on the face of it, and I'll get some details on it in just a second. But it is not telling you that the economy is super. Now, a lot of this may be dependent on the amount of service station work that was done or spending that was done. And service stations were down 4.2% because, of course, gasoline prices fell, and this is measured in dollars. Jobless claims. Jobless claims. Look at this, guys. 213,000. The number last week was revised to 218 from 222. So jobless claims going in the other direction. The labor market looks like it is staying still very strong. 1,403,000 continuing claims, which is down from 1,473,000. And so people are getting jobs. Right. That's really good news. The Empire manufacturing number rises to negative 1.5, but remember it was negative 31.3 last month, so a correction there. Business is better. We see that new orders are up and shipments are up in the New York Fed's measure of manufacturing. It also shows a big drop in prices paid, which the Fed will like. Philadelphia. Down at the Philadelphia Fed, their reading falls to negative 9.9 from positive 4, from positive 6.2, which is pretty good. It is a bad news, not pretty good. What's pretty good is the prices paid. I'm looking ahead at that, 29.8 down from 43.6. So that's 2 regional Feds telling you that companies are paying less and charging less. And then finally, we get the import price index. It falls a 1% drop. That is after a 1.5% drop last month, and that is largely going to be due to oil prices. But it is also a sign that maybe inflation is beginning to get arrested. Now, all of these are backward-looking numbers, but they are better on the whole than perhaps we expected.
We need more data.
And that's good. Mike, thank you for running through
hang on,
all
Tom.
of
We get
the
some
incredible. There's more. I'm sure that there is more, right? The industrial, business inventories will come out around 9:15. We're looking right now at a muted price reaction, but on the margins, the bad news is good news. Sorry to do this, Tom, but what you are seeing, S&P futures now have retraced some of the losses down just 0.15%. The euro gaining a little ground over dollar softening just a touch, and the 2-year bouncing back from some of its most extreme levels. What are you looking for, Mike, when it comes to retail sales not coming in as robust as expected? Will that be enough to do anything with the Fed's meeting next week?
Well, they got to take apart the numbers. No, it's not going to change anything next week. But in terms of the longer-term outlook, what is the difference that lower gasoline prices have made? This is also the back-to-school season, and taking a look at the clothing and accessories category, it's up only 0.4. General merchandise stores, though, up 0.5, and department stores up 0.9. So some money did go into other areas, but whether it comes out of savings or not, we don't know. Food services and drinking places, that's the only services number in this, is up 1.1%, which is a reasonable gain for that. So people did spend a little more money maybe that they weren't spending at the pump on other things.
Michael McKee, thank you so much. In New York, and of course, good economic data here. We are data dependent to the Fed meeting on Wednesday. Someone that knows this is Kathleen Bostjancic, Chief U.S. Economist at Outford Economics. Kathleen, I would suggest the rhetorical debate right now is the strength and the spirit of the American consumer taken in aggregate, or maybe the haves booming, maybe the bottom of the rung helping the haves get along with life, and the middle class flat on their back. Which is it into this Fed meeting? What is the state of American consumption?
Hi, Tom and Lisa, happy to be with you. So, looking through these numbers, it looks as if we lost some momentum for the consumer overall, particularly that core retail control number that Mike talked about. That's one that we look at because that feeds directly into consumer spending and GDP. And that did look a bit slower. And that's sort of in line with what we're thinking is we're going to see less ability to tap into those excess savings. Really, you talk about the different cohorts. Well, the lower and middle class have really probably extinguished all of their excess savings. Where it really lies, $2 trillion or so, which is sizable, is really with upper income households, which are less likely to use it to tap into that. So the key is going forward, and the mix of everything is really the labor market, because if we're correct when we're thinking the labor market's going to start to slow here, and that's what the Fed Reserve wants, that's going to hurt income and then eventually is going to slow consumer spending even more.
Lisa, how do you slow a labor market with 213,000 claims?
That's exactly where I wanted to go.
I knew that.
And Kathy, that's where I wanted to pick up, that right now we are looking at a labor market that's incredibly strong, and the latest numbers that we saw with the unemployment filings just confirms that, suggesting there really is not that much slack in this labor market. What's your sense of how that's going to change?
Yeah, you're correct, and it really does put the Federal Reserve in a tight spot. I think what it means is they tighten more ultimately, because what's going to happen if the labor market doesn't loosen and weaken as we think, and we do think that will happen, the Federal Reserve just has to do more. They need to bring wage growth down because it's service job wage growth that's really driving core services in the CPI report, right? And ultimately, that's what the Federal Reserve has to start to bring lower.
Kathy, This is something that drives our listeners and viewers nuts. We want a institutional government policy to diminish wage growth. Is that what we really want?
It doesn't sound great, but at the end of the day, it's overheating. It's too fast for the economy's own good, right? That's the problem for the medium to long term. Pre-pandemic, wages were running 3% year over year. Now, you could argue maybe that was a low, but now we're 5%. And we don't have the productivity gains to go along with that. So you're going to see a corporate profit margin squeeze. And that's what's going to lead to slower labor and employment growth, really.
All right. Kathy, take it over to something we haven't talked about, and it's odd that we haven't done that from across the Atlantic, and that is X minus M trade. Does trade in any way, exports and imports, does it devolve into the Fed discussion announced Wednesday?
Plays a minor role. We're still largely a closed economy compared to other countries. Now, we will see some knock-on effects from the recession we believe is going to unfold in Europe, right? That looks more than likely at this point. But it's really the confidence. That's going to have a confidence effect on CEOs, not so much a direct impact, right? If you look at European exports, for the U.S., it counts for 2% of our GDP, so it's pretty small. I think the bigger issue maybe for the Fed, and they won't talk publicly about it, but it's the strength of the dollar, right? And that's, there's good news and bad news. The good news is it helps bring inflation down. Bad news, it hurts multinational companies when they repatriate their earnings back to the U.S., right? So it just adds to the idea that we think eventually companies are going to have to pull back on the hiring reins.
So I want to go back, Kathy, before we let you go, to the philosophical point that Danny Blanchflower of Dartmouth raised, where he said that there is an asymmetry of risk and that Fed Chair Jay Powell is looking at it wrong, and that if we get unemployment higher, which is essentially by design with some of these rate policies, that it will become entrenched and it will be a bigger loss for the economy than just leaving rates low for longer. What's your view?
Well, no one wants people to lose their job, right, and to see the unemployment rate go up. But the worst outcome, I believe, it would be if we see inflation remain elevated to the medium to long term. It just obscures, right, it gets in the way of business decisions. And it really does put pain disproportionately on the lower income households. They're facing much higher inflation rates than the rest. So it's a little bit of pain in the near term. Hopefully it's in a mild recession, but it does look like we're headed towards recession. And the Fed's is going to take that bet, right? They're going to say mild recession or a recession is better than having inflation linger on.
Kathleen, thank you so much. Kathy Bostjanski with us with Oxford Economics. Nuance there and some of the dynamics that we are seeing. It was a quiet day in London yesterday, not in a state of exhaustion, but the symbolism of the covenant. I thought Lisa John Farrow was just brilliant on the path from Buckingham Palace to Westminster Hall. It is a quiet day today with King Charles resting southwest of London at his home of any number of years, his private residence, if you will, a day of rest. Lisa and I need a day of rest as well, but certainly King Charles needs one as well. An announcement made of a reception for visiting state leaders, including President Biden. Look for that on Sunday before the Monday funeral. And Lisa, I was reading in the Times of London today the present list of world leaders coming, and it is humbling how important this queen was to all around the world.
She was an ambassador in such a massive way for not only a nation, but an ideal for many years. And clearly, with the honor being paid to her, it's really represented here.
We'll see the Emperor of Japan there as well. Anna Edwards leading our coverage on Monday morning into Bloomberg surveillance. David Merritt joining us as well from near Westminster Abbey. Right now, we are going to continue. We do so off of this economic report with a churn. I would give attention to the dollar with some strength. Please stay with us. This is Bloomberg. Good morning.
Keeping you up to date with the news from around the world. With the first word, I'm Angel Feliciano. A marathon bargaining session has led to a tentative agreement that to avert a railroad strike in the U.S. The Labor Department says that after 20 hours of talks, railroad companies and unions representing more than 100,000 workers reached a deal. A strike would have frozen critical infrastructure that transports about 40% of all long-haul cargo in the U.S. In China, economic growth has slowed so sharply that several major banks don't even think a 3% increase is achievable. Projections have come down steadily since March, and the consensus in a Bloomberg survey is for the Chinese economy to expand 3.5% this year, the second weakest in more than 4 decades. The official data for August comes out Friday. Top executives from about 20 leading global firms have committed to flying in for Hong Kong's financial summit in November. Bloomberg's learned that CEOs at Morgan Stanley and Citigroup are prepared to come. Attendance by many of Wall Street's chiefs is still contingent on Hong Kong ending its 3-day quarantine for incoming travelers. Adobe has agreed to buy software design startup Figma in a deal valued at about $20 billion. It's the biggest ever takeover of a private software company. The acquisition will help Adobe expand its tools for creative professionals. Figma allows customers to collaborate on software as they build it. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
Bloomberg Surveillance from London. Again, we'll continue our coverage of the remembrance and ceremonies for Queen Elizabeth, and very importantly, we'll have coverage for you of the funeral Monday morning in the 12 noon hour roughly in London, and in the early morning of New York. Anna Edwards leading our coverage there as well. And we'll continue our coverage here through the day and tomorrow as well. Lisa Bramwitz and Tom Keene. John Farrell on assignment, and joining us now is someone who understands that one of the great engineering marvels of America is in Pennsylvania. He is the senator from Pennsylvania, Pat Toomey, and he knows that Altoona, there is a place where the Norfolk Southern Railroad, plain and simple, makes a loop, a turn. To see it, folks, is to believe it, and this is the Pennsylvania Railroad deep in the heart of his Pennsylvania. Pat Toomey, on the railroad strike, the president suggested it is Union America. Is it Union America?
Well, I'm not sure what exactly he means by that, but look, it's good news if we've averted a strike that could have cost the economy $2 billion a day. So I'd like to see the details. Let's see if this actually is going to hold. It was described by the White House as sort of a temporary thing, but this would be pretty devastating if this strike went forward. So let's hope we've dodged that bullet.
This is something we rarely touch, Senator, but I must touch it today. Kaylee Lyons, who does our crypto show, says you must do it now with Pat Toomey, and that is Bitcoin and crypto and the frustration over what the SEC has done, led by Gensler. You'll have hearings on this week. Kenneth Rogoff of Harvard University told me he was thunderstruck at how slow regulators have acted in the United States. He is definitive on crypto. Have they been too slow?
So I think the problem is that the SEC isn't sharing with us the framework that they're using. Gary Gensler famously argues that virtually all crypto tokens are securities. I think reasonable people can disagree with that. He would exempt Bitcoin from that classification, but pretty much everything else he says is a security. But then he doesn't go on to say how we would apply the existing frameworks that we use to regulate securities issuance and trading to a very, very new and very different technology where some of these things don't fit, right? Custody rules, clearance rules, these things don't have any application. And he hasn't provided any clarity on that. I think actually Congress should step in and provide some guidance. I think crypto is sufficiently different, even if you want to argue that these tokens are securities. You go ahead and make the argument, but you can't dispute that they're very different from a stock or a bond, and therefore Congress ought to step in and provide a framework. I'm working on that. That's going to be really hard to get done. In the meantime, Chairman Gensler owes us much more clarity on how and why he intends to apply SEC regulations.
Senator, I know that you are retiring from the Senate. Do you plan to go into the crypto industry in private sector?
I have no such plans whatsoever. I don't have anything lined up. I've got no commitments, no offers, nothing. I'm not pursuing that until I'm out of office. I've got a big job to do. I'm going to run through the tape, do this job, and then come January or February of next year, I'm sure I'll start having conversations, but I have no idea what those conversations will be about.
Senator, we got some data earlier this morning showing a lot of resilience in the economy, so much resilience that people are suggesting the Fed has to go pretty far with respect to rate hikes, including an unemployment rate that continues to remain low. Are you comfortable with an unemployment rate rising in response to tighter rates if that's what it takes to get inflation under control?
So first, let me say, I've always been a skeptic about the Phillips curve. I'm not convinced that you have to have significantly higher unemployment in order to get inflation under control. But the Fed's first job has to be a stable dollar. We don't maximize employment over the long haul unless you have a stable dollar. I also think Jim Paulson on your show earlier this morning made some very, very important points about all the ways that tightening is occurring outside of the Fed funds rate per se. That's all going to work its way into diminishing the pressure on inflation. And I'm hoping, look, the Fed's got a great luxury that you don't have in other parts of the world, and that is they have the ability to tighten at a time when the economy is still very strong, employment is very strong. They need to get the inflation job done here.
Well, that was, you okay there, Senator?
We were late, don't worry.
Okay.
Carry on.
Senator, I noticed you're sterling academics, you're working foreign exchange, and then you did one of the toughest things in the world, which is run a restaurant. It is tough, tough, tough. This is a restaurant in Allentown, Pennsylvania, years ago. People running restaurants right now are getting hit over the head.
Totally.
With inflation, with fixed costs, with variable costs that are becoming fixed costs, and also the labor conundrum. What is the action we can see from the Washington you leave to assist Rookie's Restaurant in Allentown?
Look, the most important thing is to end this volatility, this upward trajectory, right? I mean, there's some companies are going to be able to easily pass on price increases, and the inflation is not going to be that big a problem, but a lot of companies can't do that. And the small restaurants are a great example. People can choose not to eat out. People can eat at home. These small businesses, mom and pop operations, restaurants and otherwise, are the ones that are most vulnerable. That's why I think Congress should stop throwing gasoline on the fire. Our Democratic colleagues want more increases and more supplemental spending, even now, even COVID spending, for crying out loud. That we should not do, and the Fed's got to stay the course. I think that's the best outcome for our, everybody working in our economy.
Senator Toomey, thank you so much for joining us. Pat Toomey is the Republican from
thanks for having me.
Pennsylvania. What he said there, Lisa, that is just so important is it's not an aggregate effect of inflation. Some people, let me suggest Apple Computer, they can deal with it.
Right.
A given restaurant in London, in Pat Toomey's Allentown or anywhere else, is getting absolutely hammered.
Well, it's this fear that some people have raised of a consolidation in big business, in big corporations that have the bargaining power with some of the suppliers that can work with trying to reestablish supply chain lines that will be more effective. And it's the smaller businesses that feel it more in their margins. And that's what a lot of people have been saying. And that's the reason why some people would argue small cap stocks have underperformed so dramatically, because of that less resilience to some of these fixed features.
Liz Ann Saunders, I thought, was brilliant on this. This is something Lori Calvasine at RBC Capital Markets as well. Ms. Saunders focusing on maybe the profit quality, if you will, of selected small caps isn't what it should be. I would go, Lisa, within this equity market after Wednesday of next week. We do a Fed meeting. Let's say we get the assumed, and the assumed is 75 basis points. Then what?
Right, and what is their guidance? What's their projection? And do they start to price in higher rates, lower growth? When do they start to pull a Bank of England type move where they start factoring in the pain that a lot of people are expecting? Or are they going to just push back and say, we don't buy it, guys, you're just wrong?
The headline this morning, and I use this word too much, the swirl of market data that we see is claims, as reported by Michael McKee, at 213,000. That is a stunning buoyant America statistic. Coming up, Michael Purvis of Tallbacken from London. Stay with us. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Struggling to hold on to the balance from London for our audience worldwide. This is a special edition of Bloomberg Surveillance.
Very
Tom
special.
Keene, Jonathan Farrow, Lisa Abramowitz. Jonathan Farrow stepped out because he had an assignment, so it's special because it is just Tom and myself, and we are seeing just that bounce. Just roll over, just not be able to hold after a morning of a slew of economic data.
I think our team did a great job of booking us through this Thursday, and that what an eclectic set of opinions we have, from a Blanchflower almost saying, look, the Fed doesn't have to work off of Stiglitz, Steenbaker, and Project Syndicate, or just saying flat out they're wrong, to the idea that consumer is remarkably buoyant. My head's spinning.
I agree. I love the idea that people are in a robust debate about whether the Fed can afford to take their foot off the brake, and then others saying, take a look at core inflation that we got from CPI. This just shows that we are in a very hot economy and that they can't afford to.
I was taught, and I may be wrong, McKee's going to correct me, but the weekly high-frequency data has value.
Well, and
claims tell me this is not a troubled America.
Which is the reason, perhaps, I'm sorry, but good news being a bit of a bad news. S&P futures down 0.2%, 39.58. No, I mean, on the margins, right? Not catastrophic. NASDAQ down a little bit more. And this is sort of the theme here. Anytime you get the idea of a Fed that's going to raise rates more aggressively, the NASDAQ sells off disproportionately down 0.3%, 12,180. And you can see really in the yield space, Tom, that's where I am watching. It's just the 2-year yield continue to grind higher to 3.82. to 8% off the earlier highs, but nonetheless driving curve inversion across the board with 30-year yields even lower on the day. We had some important economic data crossing the wires this morning. U.S. retail sales leading the way, although, Tom, you're right. Unemployment data was really actually quite interesting. Okay? That was great. No, the jobless claims. Fascinating. Michael McKee, what caught your attention?
You know, it's the price data that catches my attention, but let's run through the numbers. As you mentioned, retail sales on a headline basis rose, but the core, which goes into GDP, did not. It was flat on the month, and the month prior was revised lower, so that has poor implications for third quarter GDP at this point. Now, all of this is being framed by the Federal Reserve and what they're going to do in reaction to all this, and I take you back to Jay Powell at Jackson Hole, who said, "Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook." So what's the totality of the data? Well, jobless claims, Tom, you were excited by this. They're at 213,000. That's the lowest since May. They've been going down, suggests strength in the labor market.
Right.
Empire Manufacturing, minus 1.5, but look where it was the month before. A big gain there. Philadelphia Fed does fall, but now those two indexes reported big drops in prices paid, and that probably matters more to the Fed. Import prices fall, and then the stuff that matters. This is the data that the Fed is going to be watching. This is what we're going to care about. Retail sales flat, as I mentioned. That's semi-positive because it does suggest maybe things are slowing, and that's the Fed's job. Payrolls were positive, but does that mean a jump in wages and salaries? I mean, that was the question raised by jobless claims. Earnings were up 5.2%, so that was a negative. CPI, 60% of the categories are over 4% at an annual rate, so that's negative. Financial conditions are looser, so that's negative. Add it all up, and maybe you make the case for 75. Does it make a case for 1%? That's much harder to make, I think.
Mike, I want to get to our guest here, but as we go to the market opening as well, my head's spinning, Lisa's head spinning, you're in charge of the economic data. What of this economic data, if any, does Chairman Powell and his set of PhDs actually use to make the forecasts before the Wednesday meeting?
Well, you know, it's interesting. They're going to be looking particularly at the inflation data that we've gotten, but they also recognize that most of it is backward looking. That's why I highlighted Empire in Philadelphia today. It's more contemporaneous data on what companies are seeing. And so they can't really base their forecast on the August CPI because that is older data, and they've got to figure out what's happening. And if the economy is starting to show signs that prices are going down, then that would influence how far they want to go.
Michael McKee, thank you so much. Greatly appreciated. Each research note that we look at has a unique character to it. With Global Equity Senior Research Analyst at Invesco, Ananya Lodaya joins us right now with an exceptionally cogent research note that describes many nuances to this market. Ananya, when you look at the mantra you mentioned, and one of them, folks, I might point out is we happen to be growing older. Thank you for that, Ananya. I didn't need to know that. But as I look at the nuances of the research note, it's what do I do with cash? Does cash have value now?
So thank you for that, Tom, and great to be here. So mantra, just I guess to give some context, is a nifty little acronym we created to talk about the big themes that excite us. Mass affluence, that's the MA. The world is getting richer. NT is new technology. We're living in a time where data is deluging us. R is restructuring. There's always a part of the world or the economy that is reconfiguring itself. And A is aging, all of us, Tom, as much as you. And within that, we find lots of interesting areas to continue to deploy capital while being mindful, obviously, of macro uncertainties and the state of affairs. But to answer your question directly, Tom, where should you put your cash? If we can just go back to Einstein for a second, even Einstein said it, right? The most powerful force in the world is the power of compounding. Buffett has frequently said compounding is the investor's best friend. So you want to put your cash in a place where it will continue to compound. And for us, that means high quality companies that have the wherewithal to survive periods of turbulence that are inevitable. And so that would be my reaction.
We've been having a debate all morning about what the Fed has to do in their role in torpedoing some of that dynamism that you're talking about in companies in order to get inflation lower. We had on one hand the Danny Blanchflower saying they really don't have to do much, they just can sit where they are. Others saying, no, not at all, they have to go much further. Where do you sit on that? What's your base case?
Our base case, Lisa, is that we ultimately look for companies that can take all these various macro variables and still live to fight another day as a starting point, right? So we start with companies that have pricing power, because no matter where inflation falls and if it ends up being out of control, you want companies that have pricing power. That usually comes from having a strong position in the economic value chain, being self-funded, having clean balance sheets, and throwing off copious amounts of free cash flow. So that is almost the starting point, and in some ways, it indemnifies you against the various range of outcomes that are possible out there. Now, in terms of if you look at all the recent data we've been getting, it's not implausible as a general base case that we still sort of sail through this with, you know, a few bruises, but generally intact as far as economic outcomes go. We've just come off of a week of very strong conferences, investor conferences, at which most investors have been surprised by the upbeat optimism of management teams. They're all very focused on cost cutting. Not a lot of them are focused on missing revenues or having existential crises, TBD, but that seems to be the base case today.
And Anya, what's the argument for selecting the right companies and getting that all right versus just investing in a 2-year and getting 3.8%, which is real income for the first time in a very long time?
Yeah, so if you invest in a company that can compound the capital it takes in at a return that's higher than its cost of capital, you should do well above the opportunity cost of investing in a 2-year. Part of that is looking at companies that have the ability to continually compound earnings, that have all the, you know, sort of the characteristics that we've just been talking about. And a good part of it is also looking at companies that have sensible valuations. And at some point, as we go through this turmoil, you're going to find things that are priced for outcomes that are so bearish as sell-offs continue that they're almost you know, buying them at the right time is a tried and tested recipe for outperforming the 2-year at any point in time.
I look, Anya, at the mix of investments right now and the complete total mystery and uncertainty there. Part of the Invesco Act is that short-term is out 1 year, 2 years, 5 years as well. I like what you say about quality equities, but what about quality bonds? What do you do with quality corporate bonds in the mother of all bond bear markets?
Well, Tom, I focus on equities. That's a very good question as far as what bonds do. So what I would tell you as an equities investor is, as we look at balance sheets out there, most corporate balance sheets are pretty healthy, to the point that you've been making earlier this morning, right? We think consumers are healthy, corporations are healthy. Most companies that had a pulse used the COVID sort of refinancing opportunities to refinance and push out their debts. So from the equity point of view, where when we think of debt, you know, we worry about, is the debt going to take down the company and sort of leave equity holders empty-handed? We don't worry about that per se.
Right. Thank you so much. Ananya Ladaya with us with Invesco today. Greatly appreciate that perspective there on the equity market and a touch of bonds as well from one of the great bond houses of America and the world, Invesco. We need to talk about something today that has to do with Newtonian calculus, which is the rate of change and the rate of change of the rate of change of something that matters to global Wall Street. And I'm sorry, we haven't talked enough about it this morning. The inversion speed right now is breathtaking.
What we are seeing right now, just the size and scope, is just dramatic. The 230s spread, these are different. Basically, the 2-year yielding the most versus the 30-year, going back to the year 2000. Yeah. The 5-year versus the 30-year, and it's an important benchmark, inverting to the most since around then as well. All of these metrics telling you that right now the Fed is going to have a policy error,
but what's the ramification? Within all the research you read, what is the ramification ramification of Tuesday 10, the vanilla spread, coming down with a vengeance to negative 40 basis points, and the unimaginable of breaking through that cup of coffee we had at negative 60 basis points. What does that signal into a Fed meeting?
In about 9 months, 12 months recession. Typically, that has been the read-through into economic terms. From a Fed's perspective, is this by design? And that is why I want to see their projections. Are they also seeing a downturn as they say, we're willing to do that by lifting rates to a certain level?
This is important. You're suggesting that within your reading and talking to McKee, I don't talk to McKee folks, but Lisa does all the time. Are you suggesting that we're going to get a Governor Bailey here with a chairman of the Fed that's modeling recession? I don't buy it for a minute.
I don't know if the Fed can afford the same type of honesty as Governor Bailey. However, how much do some of the projections, the economic forecasts of the individual members start to reflect that perhaps it's a lot lower growth than they previously had penciled in?
Well, you know, we're going to have to see here. It's for the dynamics today, folks. And again, just for a cup of coffee here, we had sterling under 115, the history of a Chinese yuan through 7 weaker Chinese renminbi this morning. And you know, within the quiet of the equity market, Dow, negative 8 points. What's that about? There's a lot going on.
All right, well, coming up, we've got a lot going on, in particular, getting the market open here in about 17 minutes. Also joining us, Julie Beal, portfolio manager at Kane Anderson Rudnick. We will talk about some of the big debates that we have been discussing. And Tom, I find it really compelling, this question, and we heard this from Jim Paulson. The Fed not going further, being positive for stocks, letting the effects take hold. Can they afford to do that politically?
That's a Fed talk, and Jim Paulson was saying ignore the Fed talk.
Right now, we're seeing futures down 0.3%. From London, this is Bloomberg.
Fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence.
all to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How are
story.
you thinking about those dynamics?
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
Don't forget, middle class build America, and unions build the middle class. That's a fact. Why am I so pro-union? They don't give you the credit. The American people don't understand. For you to get to go through the apprentice program and other trades, you got 4 or 5 years, like going to college. You're getting paid a little bit, not a lot, but you're working like hell before you get certified.
President Biden speaking earlier today in Detroit. We do have some more economic data crossing the wires. Let's go head back to Michael McKee. Mike.
We are looking at the totality of data, as Jay Powell suggested, and industrial production has some clues to where the economy is. It falls by 0.2 during the month of August. That's after a 0.5% gain, revised down from 0.6. Capacity utilization is a little bit lower, 80% compared to 80.2. Manufacturing up just 0.1 on the month, and auto production, despite what Joe Biden was saying, auto production, one of the reasons that manufacturing slipped from a 0.6 gain in July. Could also mention that the reason the headline dropped so much is a big drop in utilities. I thought it was hot during the month of August, but Lisa and Tom, I think maybe people didn't have to run their air conditioners around the country as much.
All right, Mike, thank you so much. We have gotten a deal also on the railroad side. U.S. railroads and union negotiators have reached a tentative agreement after 20 hours of talks. President Biden saying in a statement, quote, "These rail workers will get better pay, improved working conditions, and peace of mind around their health care costs, all hard-earned." We have Anne-Marie Hordern here. Anne-Marie, what do we know about the agreement and what it took to reach it?
Well, it took at least 20 hours of straight negotiations. That's what we learned from the Labor Department, with also the president phoning in on these discussions. Remember, this is something incredibly close to him. He was just yesterday in Detroit being introduced by a union labor worker who said this is the most pro-union president we have ever seen. So it could have been incredibly catastrophic, really, for his presidency and ahead of the midterm elections if there was no agreement. But we should note, right now, this is just a tentative agreement. What we do know is there does seem to be some open language when it comes to attendance on medical leave. There's a 14% wage hike effective immediately, 24% overall over 5 years, and this is according to the National Carriers Conference Committee. But the scheduling of sick days at this moment, it does seem to be like that's a gray area. And we should note that while this does extend this cooling off period, which basically means that you cannot go on strike, so there will be no strike on Friday, you still need to get rank and file of these labor unions to sign off on this. So it's not a done deal just yet, but obviously all things look a go.
What do Republicans think of this, Anne-Marie? I haven't got a straight word from anybody. How does the GOP handle this two-day mess?
Well, they handled it yesterday by putting legislation to the Senate that would basically be a vote on the agreement that the presidential board, that President Biden set up, that these contracts and this agreement that they said that you should potentially accept, this was what one of their advice basically was. They said this should be the law and both sides should accept this. That was struck down. Senator Sanders objected to that. And really, for the Republicans, it was almost a way that they were almost game theory playing this out. If there were to be a strike, and the Republicans were the ones that put this legislation on the floor to avert it, it would have really blown back. But right now, there's not much they can say, because at the end of the day, there was a tentative agreement that is reached.
Emery Horton, thank you so much. Greatly appreciate it here as we move forward here on the debates in Washington to the midterm elections. Julie Beal is with Kane Anderson Rudnick. She does not look at the midterm of elections. She looks at the mid-capitalization of equities with some real expertise in small cap, mid cap as well. Julie, I look at the mid cap, small cap, and particularly away from mid cap towards small cap, is everybody cheerleads and they don't happen until they happen, and then it's boom, small cap takes off. Are we there now?
I don't think we're quite there yet, right? Because there's still so many contrary indicators to how well the economy is doing. We know that employment is strong, but the fact that employment is strong is actually what gives the Fed the most amount of room to be able to raise rates pretty proactively. And I think they have to after all of the most recent prints. So, I think it's important to keep in mind that quality small and mid-cap names have demonstrated that they can be resilient in downturns.
This is really critical, folks. What you just heard there is from a grizzled pro. She's not grizzled, but we'll go with it. Julie Beal, this is really, really important. Everybody knows how to figure out if Apple, Amazon, Bristol Myers, if they're quality. How do you determine on the income statement that a small cap is quality?
Well, I think what's really important is to look at the durability of earnings. So anytime we're looking at an interesting business here at Kane, what we do is we just look at the financials through the last financial crisis, and some of our companies have financials going back 20, 30 years. And we just see how well they did. How well are they able to reduce their costs in a downturn? Do they have a lot of variable expenses? Are they able to keep their contracts with their customers? Are they mission critical software that you can't get rid of? Those are the types of businesses that can really weather the storm. Look at Jack Henry. That serves financial services. You can't tell that it went through a financial crisis on its income statement.
Julie Beal, just real quick here, you are going to be sticking with us. How invested are you? And this is sort of the tipping point of people who are bullish versus bearish, and you say we're not quite there yet in terms of recognizing the pain. How are you arranged for that?
For us at Kane, we don't try to forecast the macro. We think that that's pretty pointless, right? Were you able to predict a pandemic? Were you able to predict a war? And it had a material impact on asset prices. So, we believe in the concept that it's time, not timing. So we stay fully invested through cycles. And we just try to find these durable businesses because they tend to do well in good times, but most importantly, they protect you on the downside. So we stay fully invested. We don't make, major wholesale changes. We don't have lots of macro strategists that come in, right? Because these forecasts, it's just too complicated to try to predict all this stuff, even if there is no war or pandemic.
Julie Beal, you'll be sticking with us. And Tom, she was reading from your hymn book, basically saying, really, we're going to really play the Fed parlor game. We're really going to try to do this.
I love what you wrote.
That's the reason why I'm sure.
Pharaoh never shows it to me. It's a 9 o'clock hour in New York, and Pharaoh never shows me what Julie Beal writes about. It was great to see it.
Well, we're gonna speak more with her coming up about how to identify some of those companies and get size and scale. Michael Purvis also joining us in a bit, CEO of Talbot and Capital Advisors. He's going to join us here around the opening bell.
We have Beal and Purvis together?
Exactly. We've got about 4 minutes to the opening bell. We are seeing a deterioration continue into the open with S&P futures down 0.5%, 39.47, and it really is driven off that short-term yield. NASDAQ futures down even more, 0.6%. Just amazing to see how all of those gains in 4 days just evaporate like that.
It's a reset.
This is Bloomberg.
what's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Big, expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the U.S. are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From London, from our audience worldwide, this is Bloomberg Surveillance live from TV, on radio. And we are looking, thank you, we are looking right now at equities that are deteriorating into the open. We are just opening now at 0.4% decline in the S&P. NASDAQ now down 0.8%, and it is really driven by the yield story. Yields up across the board, particularly on the front end. You are seeing fluctuations for the dollar. But really, this has been the story right now. People are expecting that hawkish tilt from the Federal Reserve. Joining us now with a look at the stocks moving at the opening bell, our own Abigail Doolittle. Abby.
Hi there, Lisa. Well, we do, of course, have this bearish tone on the morning, but one bright spot, the rail stocks, Union Pacific in particular, up 1.7%. This, of course, after the Department of Labor earlier this morning did say that the rail companies did reach a tentative deal with the union. One issue around it, healthcare, seems to be a reason to think that it will stick. So you can see a bit of a relief rally. Union Pacific into today down 6%, but mostly to the downside, we have other stocks. Amazon in particular down 0.7%. This, of course, yields are higher. That's pressing on big tech. But Amazon also, California is saying that they are keeping some prices artificially high. Investors not liking that. ExxonMobil, energy down as oil falls. And then Adobe really plunging down 13.3%. This after the company gave a revenue forecast that's not quite great. And they also made a $20 billion acquisition of Gitmo, or Figma, excuse me, the collaborative software deal. They think that it's going to be a big positive. But as you know, Lisa, often when acquiring companies announce the deal, the stock falls as investors try to figure out what it means for the numbers.
Abigail, thank you so much. Big name investors warning of further downside in stocks. Kaylee Lyons joining us now from New York for more. Kaylee.
Yeah, Lisa, I feel like someone should check in on the billionaires because it seems a couple of them have caught the gloom bug, possibly from you. One of them being Ray Dalio, who earlier this week was publishing on LinkedIn saying he sees interest rates potentially needing to go to between 4.5% and 6%, perhaps the upper end of that, given the upside surprises to inflation. And he did the math and says that would equate to about a 20% plunge in equity prices. is back down to around the 3,100 level because he says those high rates are going to bring down credit growth and spending in the private sector and then the economy overall. And it's an eerily similar warning we got from Jeff Gundlach over at DoubleLine, who said earlier this week he is worried about the Fed overdoing it and damaging the economy, and that he agrees with calls that we could see stocks dropping another 20% by mid-October. He ultimately has a target of an index around the 3,000 level. So pretty in line there. Tom, is a lot of bearishness that is out there. I will just say we can check history a bit as a guide here, just in terms of the performance of the S&P 500 in recessions in the past. Oxford Economics took a look at that. The current drawdown, about 24% from the peak to the trough in mid-June. That is in line somewhat with U.S. recessions over the past 15 years. The average drop there was 34%, but in severe downturns like 73, for example, it's a lot more than that, Tom.
And for those of you on radio, that was a Bramo chart if I ever saw one. Katie Lines, thank you. Let's talk to the billionaire Lisa Bramowitz about this right now. I mean, the gloom is tangible out there, and frankly, away from the fancy people, you see it on the tape where a bid just can't be found. Dow down 88 points, SPX. We weren't there 3 hours ago.
We'll be tracking that throughout the day. I do want to bring some breaking news that Roger Federer, the tennis champion, has announced his retirement. He said after this season, it will be his last. And he was writing a memo, a letter to his tennis family and beyond, which he posted on Twitter. And he said that he's worked hard to return to full competitive form from all of the injuries, but I also know my body's capacities and limits, and its message to me lately has been clear. I am 41 years old. I must recognize when it is time to end my competitive career.
And he did the style. I go back to Stan Smith on this, but it was grass. And I remember when he stunned the tennis world. He was a young thing out of Switzerland, and he beat a guy named Pete Sampras. And I was like, oh, who is that guy? And basically, earning well in excess of $100 million. He's done that for his entire career. Who is this guy?
Yeah.
He doesn't win in clay. He doesn't do well with the French Open.
Well, he broke the mold of big serve, and that was the end of tennis.
Exactly.
There was actually more of a game to watch.
It's a game.
Yes.
And he truly was with Pete Sampras years ago. Who is this guy? Mr. Federer, and of course with a lot of philanthropy as well. Right now we continue the dialogue here. SPX down 15 points is well. The Dow sliding as well. Michael Purvis with us, CEO, founder of Tallback and Capital Advisors, and continuing, Julie Beal continues with us as well. Michael, I got to talk about the Gundlach-Dalio gloom that's out there. What does that signal to a grizzled equity guy like you?
Look, I mean, I think there's been a wide range, a chorus of very bearish views, not just from those guys, but from others there. I think, you know, to my mind, the economic data that we've been getting has not been fantastic, but it has not sort of really spoken to the, oh, yes, we're clearly going into a recession. And I think there's another case that I'm partial to, which is really that we're in a high nominal GDP world that's really chaotic. There are some recessionary trends and so forth, but that doesn't necessarily have to mean gloom there. And if you look at forward earnings estimates so far, you've seen that borne out. If you look at the ISMs so far, you've seen those really, retain, pretty healthy levels, especially after a massive surge last year. That's pretty unusual here. So I think it's if we do go to 6% on the 10-year, yes, there's no question you're going to see economic implications and probably some more PE contraction.
Right. Okay, Julie Beal, you got to answer this. You got to respond to Michael Purvis on this, and that he, like me, is looking at a unique nominal GDP. Is that an animal spirit enough to support revenue change and earnings change?
I think you have to ask the U.S. consumer how they feel about nominal versus real income growth, because they're still driving 2/3 of the economy. We're coming into the very critical holiday season where so much of that economic activity actually happens. And, their wages are not keeping up with inflation. So I remain concerned that the consumer is on pretty shaky footing, particularly if housing rolls over, since that is the primary source of wealth for most average Americans. It's pretty concerning to me why they're going to be out there and continuing to spend. And, we talk about the U.S. consumer like it's this, thing on the side, but we're U.S. consumers too, and we're business owners and managers. I think business confidence isn't as strong as it could be, and I think it's only going to continue to weaken as we go through the year.
Michael, we've been talking a lot about how obnoxious the good news is bad news and bad news is good news and bad news is bad news, whole paradigm is, and we hate it, and everyone's saying, yeah, but it's kind of true. Are we in that bad news is good news and good news is bad news paradigm, or is that sort of too simplistic at this moment?
I'm not sure that's the best lens to look at the markets. Look at the CPI print that we got the other day, and the market reaction. Well, the CPI print off the June CPI released in early July was arguably worse in many respects, but the market reaction was benign, whereas the May CPI print, it was a pretty ugly reaction like what we've just been experiencing this week. And I think you have to look at two things there. You have to contextualize the CPI prints for what is the level of the equity risk premium coming into the print, which was way too low this week, which was way too low coming into the May print, but it was actually pretty healthy coming into the June print there. And the other condition also, if you look at the price reaction in equities and bonds back in May and off the May print and back off this print we got this week, is that the technical position and the absolute level of the 10-year Treasury yield was really vulnerable. You were looking at fresh highs here. So then you get a report that just sort of affirms that we're opening a new range of 10-year interest rates and all interest rates, right? But for equities, the 10-year is what I focus on. And all of a sudden, 4% doesn't become an idea; it becomes much more of a tangible reality there. And that I think was part of the problem there. So how these inflation prints get, you need to read how the setup is coming into the print. It's really important.
Julia, I'm curious from your perspective with looking at specific companies and what can withstand whatever weakness we see, how much conviction is there to invest? Would you reward a company for investing in growth later on, or is that a warning sign for you that they're not recognizing some reality?
Well, I think not all investments are created equal, and when we meet with our companies, we talk a lot about how they measure the return on their investment when they're investing in sales and marketing or R&D, and following a lot of the technology businesses, you could say that they were spending hand over fist without any kind of real clarity on what the return on investment was going to be, because all they were chasing was revenue growth. And now that the mindset is about durable, profitable earnings, that's different. So I think, again, it's helpful to have history. It's helpful to talk to companies and see how they're measuring the productivity of their investment. But I think great businesses are able to invest into downturns and further solidify their competitive position. So depending on the investment, it just depends on the quality of how they're thinking about it.
Julia, the time that we've got left to do, Michael Purvis, folks, is going to continue with us. I am watching in real time second derivative acceleration or convexity in the 2-year yield. Bring it over to the equity world. The fact is, literally, with Lisa, John, and I moving break to break, half hour to half hour in our blur in London, the 2-year yield is just walking away from us on a vector to 4%. What does it actually mean I should do in the equity space?
Have that kind of rate volatility but motion higher. I think you just have to be more thoughtful about valuation, and you really have to be confident in the level of your fundamental earnings, right? Because if we're going to be discounting them at higher rates, they're going to be worth less. So I think that's really the critical focus, and you see that time and time again where high valuation stocks get punished.
Does that signal that we get what Michael Purvis calls a buoyant nominal GDP, that the x-axis of big nominal GDP stuns us and continues forward? Is that part of the mix that the 2-year signals?
Yeah, I think that's possible. I think it's really possible for that to be the impact of it. But the thing is, it's really hard to tell, because the thing about demand is it can turn around pretty quickly. We've seen that happen before. So if housing rolls over, for example, you're going to see a major pullback in demand. It's going to be powerful.
Julie Beal, thank you so much for being with us. Michael Purvis, you're sticking with us. Coming up, we'll take a look at what to expect with Europe facing new hurdles as the bloc attempts to contain the energy crisis. That's been a huge theme for us, Tom, as we've been here in London, just people grappling with this and the prices that keep rising at really incredible paces.
Here it's tangible, as we knew before, but to live it, to see it here is shocking.
Yeah, especially. And the question of how do you control it, and we were speaking about this with Jeff Yu, how much can some of the authorities control markets in ways, and then on the front end and then on the back end, in a way to make it more palatable for consumers as they deal with the very tangible reality of just not enough gas?
In the arch debate, and this goes to Clarida, I'm sorry, but this thing with Richard Clarida on Wednesday, folks, mark your calendars, 2 p.m.-ish, Wednesday afternoon, the three of us with Richard Clarida, the former vice chairman of the Fed. And this is a different Richard Clarida. As a public official, he had to really toe a certain dialogue, a certain set of adverbs and adjectives. This will be a different Clarida. I'm fascinated what he thinks is the response to higher inflation, not now, but into November, December, and into next year.
I just want to ask him if Neil Kashkari has a Bloomberg terminal on his desk, and he's looking at the financial conditions index and saying, you know, stocks are too high. Let's bring them down.
This is the former dean of Columbia Economics. I don't think he's going to go there.
All right. S&P, I should say, is open, trading down 0.2%, 39.37 from London. With Tom Keene, this is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth. And codifying that using AI sensors and computers is turning out to be a lot harder. Last but not least, it's a safety critical system. None of us should deploy until and unless we have closed loop evidence that we're safe.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
That it is very important to send a clear message. We take care of our households and business, but at the same time, we are not going to give any discount to Russia. Sanctions are here to stay. We will stay by Ukraine as long as it takes.
The big issue of Europe, investors weighing whether the EU's steps to contain the energy crisis will be enough to curb prices. Bloomberg's Todd Gillespie and Taylor Riggs joining us now. Todd, let's start with you. We've heard a number of steps, efforts to try to cap prices, different approaches from the EU, from the United Kingdom. What's the latest on the EU's plan?
Yeah, well, one of the latest things out of the EU at the moment is this new talks with Norway to try to cap the price of gas that the EU can import from Norway. Bear in mind, Norway isn't an EU member, but it is in its interest to kind of produce some more price stability. So this is the latest in a wave of reforms that the EU is trying to put in place to kind of stabilize the market here, on top of plans that were announced yesterday, including a sort of windfall tax, essentially, a sort of a cap on the price of power that's produced by non-gas and non-coal-fired generation, also a windfall tax on fossil fuel generation and on fossil fuel producers, and also targets to, most interestingly perhaps, targets to reduce power demand at peak times across the EU as we head into winter, sort of managing and mitigating the risks of blackouts across the bloc.
And Taylor, we've really seen the ramifications, or the effects, I shouldn't say negative. They're really, in terms of the energy crisis, positive and driving down some of the natural gas prices in Europe. What's the latest and the thinking of how much further it has to go?
Lisa, let's go through the price action for you. This really tells the story within the data. Take a look first at the massive dollar strength, really, that has been the theme of the year. That continues a little bit today. And then, of course, the pressure that is putting on commodities. As you see, crude, copper, even gold sort of decline here on the day. Maybe some concerns here about the economy, a slowing economy, as you really get a lot of the Fed moves pushed forward, and that also contributing to some of that dollar strength. You are in Europe, Lisa. I do this chart for you. Euro nat gas futures, a volatile ride this year. And of course, a big outperformer when you think about some of the U.S. nat gas contracts as well. So really seeing some pressure there on those energy prices over in your Europe. Year to date, Lisa, just take a look here. We're taking a look at the Bloomberg Energy Spot Index, huge. Agriculture, of course, as we're thinking about some of the ripple effects of maybe that rail strike, at least for now, that has been mitigated. But really, it's sort of the industrials and those precious metals that are on the decline year to date. Really some concerns about the economy led by a slowdown in Europe and how that ripples back through here to the U.S.
Todd Gillespie, Taylor Riggs, both of you, thank you so much. This is the pressing issue for so many in Europe, and saying it is going to trickle out to the rest of the world. Michael Purvis still with us, CEO and founder of Talbot and Capital Advisors, and that's really the key question: is how much is the roll-off in inflation, at least headline, simply due to energy and due to some of these sort of top-down efforts to lower prices, and how much is due to demand destruction that will be a more persistent disinflationary force?
Well, you know, that's one of those questions that it's really hard to answer. But I think one thing that is pretty obvious is that the supply side here across hydrocarbons and many metals will be probably very tight for a long period of time. If you look at the behavior of how corporations are reacting to this, you know, yeah, sure, they're playing ball with policymakers in some form or fashion, but there are a lot of structural factors that are going to support a tight supply situation. So it's hard to imagine a lot of prices going back to the levels that we associate with pre-COVID. And And I think that is going to be sort of one of those reinforcing factors of why currencies like the euro and the yen, which are very hydrocarbon vulnerable relative to the dollar, are going to stay in a weaker, longer position.
Michael, that's right where I wanted to go. We can celebrate this till the cows come home, Michael, but the bottom line is you have one of the great calls on ADXY, I should say, which is the Pacific Rim Currency Complex, X the yen. And it is a Purvis chart that is absolutely grim. What kind of path is that if it stays weak? If ADXY goes out to new weakness, Michael, at some point institutionally, those nations have to break.
Yeah, well, you saw the yuan, which anchors that index, get through 7 today. One of the interesting things about the Chinese currency is simply that, in 2021, it was one of the few major currencies that rallied against the dollar, and you could look at real rate differentials, and that told you that story. Real rate differentials were actually favoring the yuan last year. But if you look at inflation in China, it's starting to accelerate. It was extraordinarily low. It was, whoever would have thought you'd have 8% CPI in the U.S. and 2% in China. But those trends, as high as inflation is here, the trend is starting to turn relative to Chinese inflation there, and that's sort of underscoring that there could be more weakness there. And that, of course, has knock-on effects to all sorts of EM assets, equities, and credit.
Yeah. Michael, I know your favorite is Blackpink, but let's talk Korea. I've barely talked about Korean won, and I'm sorry, on a log-second derivative basis, it's an unwind. What are the ramifications for the Pacific Rim on your great weak currency call of a Korean won absolutely out of bed? There's no other way to put it.
One of the interesting things, this may be changing over the next couple of weeks there, but if you look at option pricing on the won, it's not really that dramatic. It's been coming up there, but every currency vol, has been in a different place over this year, certainly relative to last year there. So it's not really signaling a oh my God shock. So what we may be looking at is a sort of a slower motion weakening of the Asian condition relative to the U.S., as opposed to sort of what we associate with August 2015, that shock devaluation in China that really kind of had massive ripple effects through risk assets around the world, including the U.S.
Michael Purvis of Talbot and Capital Advisors, thank you so much for spending the time. And that really, to me, is sort of the underplayed story, the currency story of the Asian Pacific region. In particular, yes, it's about the weakness that you're seeing in China, and that really has been what's driving it, and the allowance by authorities to let it weaken. And that, I think, was notable today with some of the withdrawal of liquidity.
It's like Priya-Misra. I mean, Misra, the great inversion call, and we're going back to Priya-Misra territory here in the 2s10s spread. That's what Purvis did on Pacific Rim. He said, look, this is what I observe. He didn't do a time bet. He didn't say 6 months from now, all the other strategists malarkey. He just said, this is a structural weak currency. I'm looking at for those of you on radio, you look at CNY and CNH. I use CNY because it's old school, but the bottom line is 7-1. We're here. It's like today is a big deal when you look at Asian currency dynamics.
I have to say, you're talking, and the more you talk, the more markets are going up. So it seems like people are kind of rejecting the bearish. We've had a bit of a turn. They are now positive, not negative. When we started, it's red and green.
The Dow is up 85 points.
Up a whole 1/10 of a percent.
What are you like, Pharaoh? You're going to ignore that we should quote the Dow?
The NASDAQ is down, but just basically
I'm never
flat.
doing this hour again.
Okay, the 2-year yields are higher. That to me is what I'm watching and sort of the driving, but not unless
I'm going to go see my psychiatrist, Natalie. She's going to straighten me out.
And I'll just keep doing this, and we are watching the dollar, and it seems to be a stasis, getting some comfort where we are. From New York. From London, this is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, There were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind